Committee will come to order. Without objection, the chair is authorized to declare a recess to the committee at any time. Without objection, all members shall have 5 legislative days within which to submit additional materials to the chair for inclusion in the record. Well, good morning. As we conclude our first session of the 119th Congress, we're moving forward over the next 2 days with a slate of bills that will take a significant step to further advance the committee's agenda for the 119th Congress. Following the conclusion of this markup, the Financial Services Committee will have advanced nearly 100 bills to the full House for consideration. Today, we're advancing smart, pro-growth banking legislation that strengthens our banking system, expands access to credit, and reduces unnecessary regulatory burdens that drive up costs for families and our small businesses. We're also considering our bipartisan package of housing measures that I'm proud to have introduced alongside Ranking Member Waters, Housing and Insurance Subcommittee Chair Mike Flood, and Ranking Member Emanuel Cleaver. The issue is clear. We need more housing units across the spectrum, from single-family homes, multifamily units, to apartment buildings and manufactured and factory-built housing. This long-brewing housing shortage is not just an economic risk, it threatens the stability and quality of life for millions of Americans who are struggling to find reasonably priced homes. While there's a cooling in single-family home prices across the nation, we recognize that when housing costs outpace families' take-home pay, many families are in vulnerable positions with less stable financial footings, which limits their opportunities and stifles our overall economic performance. Our housing package will tackle these challenges head-on with a comprehensive package of bipartisan housing policies representing our committee's commitment to ensuring that every hardworking American has access to housing and the capital they need to support their family. Our committee has spent countless hours crafting a bill to create real, tangible solutions that will streamline housing development and affordability by updating outdated programs, removing unnecessary federal requirements, and increasing local control. We have provisions to streamline the permitting process and reduce regulatory barriers so that we can expedite the construction process on new homes and meet the growing demand. Other provisions seek to improve federal housing programs through updated standards, better administration, and support for innovation in manufactured and factory-built housing. By focusing on policies that encourage the construction of new homes and streamline the development process, we can provide more opportunities for families to find safe, reasonably priced places to live. Our members recognize that addressing our housing challenges require collaboration and innovation, and this bipartisan package is a step in that right direction. I look forward to our discussion on these important bills and hearing from our members on how we can address the housing crisis to ensure every American has access to housing so that we can create a future where families can thrive, communities can grow, and our economy can prosper. I'd also like to mention early next year we'll be taking steps to advance our Making Community Banking Great Again agenda as well. Not only are community banks often the primary lenders for first-time home buyers and low to middle-income families, but our banks are an integral part of the nation's housing finance system. The reforms in our housing package, coupled with reforms to ensure community banks can focus less on compliance and more on lending in their communities, will help ease this housing access and availability crisis. I look forward to the discussion today, and I yield back. Now recognize the ranking member for an opening statement.
Thank you, Chairman Hill. I never thought today would come, but I'm so pleased that we're finally here, marking up a bipartisan housing bill at long last. While I was disappointed that the chairman walked away from efforts to include housing legislation in NDAA, I commend him for his leadership and pleased to join with him in moving our bipartisan bill, the Housing for the 21st Century Act with Congressman Cleaver and Flood. This bill is long overdue, and it's a first step to expand affordable housing, modernize key programs, and help more families achieve the dream of home ownership. But let me also be clear. Although it is a strong step in the right direction, this bill alone will not solve all of our housing crisis. We must build our way out of this crisis, and only the federal government has the funds and, more importantly, the will to build the millions of units we need to end this crisis. This bill should be seen as a great starting point, not a finish line, and I hope that the spirit of bipartisanship that brought us here today will extend to securing the additional investments our country needs to deliver the bold, comprehensive solutions this moment demands. In addition, we as a committee need to rein in the efforts by the administration to reform Fannie Mae and Freddie Mac. This committee should play a central role in discussion, not the unserious and unqualified director of the Federal Housing Finance Agency, Bill Pulte. While we are finally coming together on housing in today's markup, I have to say that many of the other bills we will consider are the same Republican deregulatory nonsense. Unfortunately, today's markup includes several bills that are essentially essentially Christmas gifts for billionaires, big crypto, and big banks. These bills weaken oversight and make it easier for powerful financial institutions to extract even more money from hardworking Americans through junk fees and other unfair practices. And these efforts are only being fueled by a president who has dismissed America's concerns about the affordability crisis as a hoax. He actually said this in Pennsylvania in front of the media, while spending hundreds of millions of dollars on a golden ballroom at the White House. But this is par for the course. From day one, the Trump administration has pursued a reckless economic agenda that has raised prices and weakened the economy. From sky-high tariffs to $40 billion bailout of Argentina to sending in masked federal agents that detain and deport Americans and others who are lawfully here. This administration is turning its back on America. Committed Democrats will never stop fighting to deliver real change for the American people. That means an economy and financial system where families can afford a dignified place to call home, working people can finally get ahead, and consumers are protected. Not one rigged for Wall Street and the wealthy few. So, I'm looking forward to us completing this good bipartisan bill today without some of the attempts by the administration to weaken it. And I look forward to working with the chairman. I yield back the balance of my time.
Gentlewoman yields back. As we begin our market, I'll start by pursuing to notice I call up the resolution reauthorizing our task force on monetary policy, treasury market resilience, and the economic prosperity of the Committee on Financial Services. The clerk will report the resolution, which was distributed in advance. Let's can you move a neighboring mic over there? Have we got a neighboring mic? There we go. Clerk will report the resolution.
Resolution offered by Chairman Hill reauthorizing the Task Force on Monetary Policy, Treasury Market Resilience, and Economic Prosperity of the Committee on Financial Services.
Without objection, the resolution is considered read and open to amendment at any point. Does anyone seek recognition? Gentleman from Oklahoma, the chair of our task force, Mr. Lucas, you're recognized to strike the last word.
Thank you, Mr. Chairman, and I thank you for the continued attention you bring to monetary policy and the Treasury market resilience. There could not be a more important time for the work of this task force. Through the year the task force has been operational, we've seen the Fed publish its 5-year framework for review, the Fed in the latest cycle of quantitative tightening, and market stress events that affect the volatility in the Treasury market, just to name a few examples. That's why it's appropriate now to renew the task force and pay special attention to the ways we can bolster the Treasury market's strength and resilience. This past year, we've examined ways to improve the primary dealer system, the Federal Reserve Bank of New York's standing repo facility, and how both banking and derivative regulations affect market participants' intermediation in the Treasury market. The task force has continued to build consensus among our members, particularly on the Treasury market side of our jurisdiction. For example, the timely and smooth implementation of the SEC's clearing rule continues to be a bipartisan priority, I should say. The task force will continue to work with our SEC colleagues to ensure outstanding implementation issues are resolved and firms are prepared in advance of the deadlines. In addition, last week, Mr. Vargas and I sent a letter to GAO requesting an update of its 1986 report on the health of the Treasury market. The market has more than doubled in the last decade alone. An audit of the market's functioning is overdue. We've also taken a thorough look at the Federal Reserve System. A key issue I'm focused on is making sure that the Fed is faithful in representing the economic conditions in all corners of our country, not just New York City and San Francisco. A federated and specialized system ensures a diversity of views at the board. The task force will continue to highlight the importance of the regional banks. Thank you again to Mr. Vargas, the ranking member of the task force, for continuing to be a good partner in our efforts to strengthen the resiliency of our markets, and to Chairman Hill for recognizing the need for this task force. And with that, Mr. Chairman, I yield back.
Chairman yields back. Who seeks recognition?
I seek recognition.
The gentleman, lady, would you like Mr. Vargas to go
him
first?
first.
Yeah. Mr. Vargas, you're recognized to strike the last word. The ranking member of our task force.
Thank you very much. I move to strike the last word.
Gentleman's recognized for 5 minutes.
Thank you very much, Mr. Chairman. Let me begin by thanking you, and along with Ranking Member Waters, for supporting the work of our task force, and especially Chairman Lucas for the collaborative and respectful way he has conducted our hearings. I had the honor of working with Mr. Lucas when I was a freshman here on the Ag Committee, and he was a great chairman, and listened to all of us and worked with all of us. And again, I appreciate it. That continues today. I have great respect for him. Our discussions have centered around both the U.S. Treasury market and our nation's monetary policy. Our Treasury market is the deepest and most liquid market in the world. And with over $30 trillion worth of U.S. Treasuries held by the public, maintaining the market's stability is essential. It keeps our borrowing costs low, prevents financial panic, and supports retirement and pensions plans. But this stability is not a given. It depends on the credit and reliability of the U.S. government. At the foundation of that reliability are strong, respected institutions, such as the Federal Reserve. And though it has made mistakes, the Fed's credibility stems from its record of prioritizing Americans' long-term economic interests. Yet the Fed's independence continues to be under attack. Just last week, in an interview with the Wall Street Journal, President Trump reiterated his expectation that the next Fed chair consult him on interest rates. And we've seen how the president reacts when one disagrees with him on monetary policy. We've seen him explicitly target sitting Fed governors. He's threatened to fire Chairman Powell, and he is currently attempting to fire Governor Lisa Cook. That kind of interference with the Fed's independence is unacceptable and can prove costly to everyday Americans. And as co-equal branch and legislative body with oversight responsibilities, it's our obligation to hold these types of actions to account. I look forward to our continued discussion on the importance of both Fed's independence and its dual mandate. And I welcome the opportunity to resume our collaboration on making our Treasury markets more resilient. With that, I urge my colleagues to support this resolution. And again, I thank you, Mr. Chairman, for this hearing and for this motion. And with that, I yield the balance of my time. Thank you.
Gentleman yields back. Who seeks recognition? The ranking member, you're recognized for 5 minutes.
Thank you. I move to strike the last word.
Gentlewoman's recognized.
This resolution will extend the monetary policy, treasury market resilience, and economic prosperity task force for an additional 6 months. Led by Chairman Lucas and Ranking Member Vargas, the task force has held constructive hearings this Congress. However, in light of the Trump administration's attacks on independent agencies, his personal attacks on Federal Reserve Chair Powell, and his illegal attempted firing of Fed Governor Dr. Lisa Cook, this task force should focus on the importance of Fed independence. Trump is playing with fire as he tries to control the Fed, which economics say could cause the markets to crash and lead to hyperinflation. So I hope the task force and the members of this committee will stand up and defend the laws that Congress wrote to make it clear that the Fed is indeed independent from the president. I thank you and I yield back.
Gentlewoman yields back. Is there any discussion on the resolution? Hearing none, we'll move to amendments. Are there amendments to the resolution? Anyone want to offer an amendment? There being no further discussion or amendments to the resolution, the question now occurs on the adoption of the resolution. Those in favor signify by saying aye. Aye. All those opposed signify by saying nay. In the opinion of the chair, the ayes have it, and the resolution is adopted. We'll now move to our next bill. Pursuant to notice, I call up H.R. 6536, the Rural Depositories Revitalization Study Act. This bill was introduced by the gentleman from South Carolina, Representative Norman. The clerk will report the bill, which was distributed in advance.
H.R. 6536, to require the federal banking agencies to study improving the growth, capital adequacy, and profitability of rural depository institutions and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. Representative Norman has an amendment in the nature of a substitute, copies of which have been distributed in advance. The clerk will now report that amendment.
An amendment in the nature of a substitute to H.R. 6536, offered by Mr. Norman of South Carolina, designated as Norm SC 028.
Without objection, the amendment is considered read and will serve as base text for purposes of the amendment. The gentleman from South Carolina, Mr. Norman, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, I speak in support of my bill, H.R. 6536, the Rural Depository Revitalization Study Act. This bill requires federal prudential regulators to jointly study ways to improve the growth, the capital adequacy, and profitability of rural depository institutions, and to identify regulatory barriers to these goals in the formation of the new depository institutions. This bill also requires a report to Congress due within 1 year of enactment. For generations, community banks have been the financial backbone of rural America. They finance family farms, small manufacturers, Main Street businesses, and first-time home buyers. They know their customers personally, they understand local risk, they keep capital circulating when it's needed the most. Over the past several decades, we've seen a steady and an alarming decline in the number of community banks, particularly in rural areas. Many of these people have no access to financing or to bank services that they can go to. The process for starting a de novo bank today is slower, it's more expensive, it's more uncertain than it has been in any point in modern history. Heightened capital expectations, shifting supervisory standards, and prolonged approval timelines place disproportionate burdens on small institutions, burdens that large and well-resourced banks are far better to absorb. Research has shown that new banks often take up to 9 years to reach the financial and operational efficiency of their established peers. During that time, they face elevated scrutiny, capital pressure, and compliance costs that can determine whether they survive at all. But here's the key point. De novo banks do not fail at higher rates than other startups. In fact, they tend to fail less frequently than many mature banks. I strongly suggest the current system is simply cautious. It is overly cautious, and in doing so, is suppressing competition it's suppressing innovation, and it's suppressing access to credit in the communities that need it the most. In 2018, Congress passed the Bipartisan Economic Growth, Regulatory Relief, and Consumer Protection Act. That law recalibrated certain supervisory requirements for small institutions and helped streamline aspects of the de novo process. Following its enactment, some states saw that their first new community banks in more than a decade. That wasn't an accident. It was a result of Congress recognizing that one-size-fits-all regulations does not work, especially when it comes to rural banking. The Rural Depository Revitalization Study Act is a direct continuation of that work. In other words, it asks a very simple question. Are our regulatory systems working as intended for rural Americans, or are they unintentionally locking communities out of access to local banking? For many rural communities, losing a local bank doesn't just mean fewer financial options. It means longer travel distances for basic services, less access to small dollar and relationship-based lending, fewer opportunities for local entrepreneurship, and increased consolidation that concentrates risk and decision-making far from the community itself. At a time when Americans are rightly expressing concern regarding financial concentration, resilience, and economic opportunity, encouraging responsible new bank formations should be a part of the solution, not an afterthought. The Rural Depositories Revitalization Study Act sends a clear and constructive message to regulators. Congress wants a regulatory framework that protects safety and soundness while also allowing well-capitalized, well-managed community banks to form, to grow, and to serve their communities. This is a common-sense oversight bill. It's pro-competition. It's pro-rural. At the end of the day, it's pro-American. I urge my colleagues to support H.R. 6536. And, Mr. Chairman, I yield back.
Gentleman yields back. Is there further debate on the amendment in the nature of a substitute? Ranking member, do you wish to speak on the amendment in the nature of a substitute?
Mr. Chairman and members, I fully support this amendment and the bill that this amendment is amending. And I have an amendment also. I think we've finally come to a time where we recognize that we need to do more support for the rural banks and the rural community, period. I'm oftentimes, just very, very disappointed that we have not been able to focus in ways that we should be able to focus on the rural community. And as for the banks, the small banks and the community banks, they want to do the kind of lending that oftentimes they're not able to do it for lack of access to the kind of capital that they should have and need to have in order to give more support in these rural communities. I think for the big banks that do not wish to do small lending, do not wish to support, the kind of efforts that would help to create home ownership in rural communities, the rehabbing of homes in rural communities, the ability for young people in rural communities to have down payments, which the federal government should help with. I believe that we should look at the big banks and, in order for them to come in and talk about not wanting to reserve more capital rather than us, having them do that, that we should say to them, you claim that you're making loans in these communities, both urban and rural, that you're not doing. And so therefore, what we're going to do is we're going to incentivize in some way or penalize, and we're going to make sure that we have access to capital for these community banks and these small banks. To tell you the truth, we really don't need a study. We really need to do it. But this is bipartisan, and I'll work with the study. But when you're ready to put some money up, to actually get some of this stuff done, I'll be right there with you. I yield back.
Gentlewoman yields back. Anyone seek recognition on the ANS? Dr. Foster?
Yeah, thank you. Strike the last word.
Gentleman's recognized for 5 minutes.
Yeah, well, thank you, Mr. Chairman. I support this bill. I, represent some rural areas with some small banks and recognize the value that they bring to communities. When you look at the problem of starting new banks, one of the biggest barriers has to do with software costs and compliance costs. That often shows up as complaints about overly complex, regulations and so on. But bank regulations are complicated for a reason. Banks fail in many complicated ways, and the regulations must be complex. What helps with that is when you have high-quality software. And I've done a little looking into the nature of the software stack that are used by banks, large and small, and 70 to 90% of it are open source packages that are used by banks, large and small, often shared between the large and small banks. And so finding a way to expand that, sort of my dream here is that if you got an approved de novo charter, that coming with that would be either a way that you could get a complete suite of compliance and auditing and just back office software for cheap or for free. For example, one way to do that is you just simply get a voucher that allows you to take it to one of a handful of providers who will put a commercial wrapper around the largely open source packages. Another one would just be to have more government support for those big open source projects that provide very low cost software. A third major cost has to do with training costs associated with that software. And here is something where artificial intelligence can make a real difference. That it is not unrealistic to imagine that in the near future you're going to have the training that all provided in an automated way for the specific packages you choose. And so this future will come to some extent naturally, but if there are things that we can do to bring down the cost earlier and faster for the smallest banks, I'd very much like to see those incorporated in this study. That was just my comment, and I support the whole nature of this study, and it will be benefit for small banks in both rural and urban areas. That's it, and I will then, I guess, take back striking the last word and yield back.
Gentleman yields back. Is there anyone else to speak on the amendment nature of substitute? You have an amendment though, right?
Yes.
But I'm not ready for
Okay.
that yet. Anybody else? I recognize myself for 5 minutes. I support H.R. 6536, the Rural Depository Revitalization Study Act offered by my friend, Mr. Norman of South Carolina. Mr. Norman grew up in Rock Hill, South Carolina. He started his career in the real estate development business, and he's seen those small towns in northwest South Carolina grow and become part of the Charlotte metro area, but he also was very familiar with independent rural banks in his home state of South Carolina. In my own instance, 25 years ago, I was an investor in a very tiny rural bank in 2 counties with less than 10,000 people in each county. The predominant industry in those counties was row crop agriculture and timber. And so I know how important it is to have a voice of a commercial bank inside a very, very small community. And we have counties in this country now that don't have any physical banking place. And as many members of the committee have heard me say before, it's really neat that people over here on the East and West Coast have access to banking on their phone. But I worked in a place where we didn't have cell service. We didn't have broadband. And so that's fascinating that all of the young people working on Capitol Hill bank on their phone and have access to all this technology. But out in the real world, across our country, we have lots and lots of counties, lots of American business that gets done in rural areas. Mr. Lucas can tell us about West Oklahoma. And so we need our financial institutions thriving in those communities. Declining populations, limited deposit bases, higher per customer operating costs, and difficulty attracting capital all make it hard to sustain a healthy, profitable institution in many of our rural areas. And when a rural bank closes, it doesn't get replaced. Economic activity slows, the people in small businesses in that area lose access to immediate credit, good advice, a trusted financial partner that's local and handy, and they have to spend a disproportionate amount of the time on the road to a bank, obviously many miles away. But these banks are often forced to operate under the same regulatory framework designed for a very different business model. H.R. 6536 requires the federal banking agencies to conduct a joint study to identify how they can improve growth capital adequacy and the profitability of depository institutions that primarily serve these areas, and identify statutes and regulations that stand in the way of these goals or discourage the formation of new rural banks. If we care about rural economic development, small-town entrepreneurship, full access to credit across our country, we've got to care about institutions that make those things possible in so many of our states across the union. I urge all members of the committee to support this bill. I thank the gentleman from South Carolina for his leadership in offering it, and I yield back. Does anyone else seek recognition on the A&S? Hearing none, we'll move to amendments. Does anyone wish to offer an amendment to the A&S? For what purposes the gentlewoman?
I have an amendment at the desk.
We'll pause while the amendment is distributed.
Mr. Chairman, reserve a point of order.
The gentleman from Georgia reserves a point of order.
Actually, the big ones, at one time, I don't know if they still do it, they would take the money that would ordinarily be considered money for banks, for small business, for small banks to do the lending. And these community development organizations could raise the interest rates a little bit on the money, but they could give it out. So, well,
The clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 6536, offered by Ms. Waters of California, designated as H.R. 653601.
Without objection, the amendment is considered read, and the gentlewoman from California is recognized on her amendment.
thank you very much, Mr. Chairman. We know that community development financial institutions, or CDFIs, and minority depository institutions, or MDIs, play a critical role in providing affordable financial products and services to communities across the country that are overlooked by megabanks and other additional financial institutions. And yes, this includes rural communities with CDFIs and MDIs providing financial access to capital and credit to farmers, churches, and small businesses in rural communities. So as we require a study of ways to support depository institutions serving rural communities, my amendment simply requires further analysis of how CDFIs and MDIs can be supported to expand access to credit in rural communities. Earlier this year, we heard testimony from LaShonda Young, a small business owner who is working on setting up an MDI and CDFI bank to serve her rural community in Iowa. It is worth noting community banks make up a larger share of CDFIs that serve rural communities, and 70% of rural CDFIs listed federal funding as key to being able to provide financial products and services in their communities. Small business financing is a top business line for rural CDFIs, and I'm proud of the bipartisan work that we did during this pandemic to help keep our small businesses open. I worked very closely with Representative Velasquez and Treasury Secretary Mnuchin to secure a $60 billion set-aside for community lenders, including CDFIs and MDIs, to deliver sorely needed paycheck protection program. That's the PPP program, loans to small businesses across the country. And while the current administration has tried to shut down the CDFI fund, I'm proud to have joined members on both sides of the aisle, including over 100 Republicans, to push back and defend our CDFIs. In particular, I want to acknowledge Representatives Kim Huizinga, Style, Sessions, Rose, Flood, Fitzpatrick, Lawler, Downing, Garbarino, Nunn, De La Cruz, and more for standing up for CDFIs. This amendment gives each of you another chance to stand up for CDFIs along with the rest of our colleagues, consistent with this committee's long bipartisan track record of supporting CDFIs and MDIs. And so I urge my colleagues to support this simple amendment so we can get more study and analysis on creative ways. We can further support these institutions along with other community banks serving rural communities. To both my friends on this side of the aisle and my staff on this side of the aisle, thank you for all the studying, but actually it's money, and we need money. And we can find money, not from the federal government, more money that the big banks supposedly are doing to give money to these community banks so that they can have more money to lend. The big banks don't want to make small business loans. They don't want you in the bank. And so the rural communities would be happy, and they work very well with the community. We should just put into law what they say they're doing and make sure that they give a percentage every year to the community banks so they can make these loans. Next time, maybe we can have an amendment. Not this time. I'd do it this time if I thought you'd support it, but you won't. So that they can have enough money to do the business that they want to do. I thank you very much, and I yield back.
Gentlewoman yields back. Does the gentleman from Georgia insist on his point of order? Who seeks recognition? Gentleman from Georgia, Mr. Loudermilk, you're recognized to strike the last word.
Thank you, Mr. Chairman. Mr. Chairman, the purpose of this bill, right-sizing regulation and encouraging regulators to reduce or eliminate unnecessary regulation, is precisely the relief that CDFIs need to continue their important work. However, this amendment is unnecessary. Under existing federal law, CDFIs are already treated as financial institutions and covered by the provisions of this bill. Singling out CDFIs risk creating redundancy, confusion, or unintended carve-outs that could undermine the clarity and consistency of the framework we are establishing. And this bill is function-based, not label-based, and appropriately applies to all financial institutions. For those reasons, I must oppose this amendment and urge my colleagues to do the same, and I yield back.
Gentleman yields back. Who seeks recognition? Seeing no one seek recognition, I'll recognize myself for 5 minutes to strike the last word. I want to thank the gentlewoman for her amendment in the sense that she has been a strong supporter of community development financial institutions, CDFI, since the program was commenced in the 1990s. She's right that during the pandemic, these institutions were awarded billions and billions and billions of dollars of unusual support as a part of the pandemic relief, and she deserves credit for her advocacy there. But I share the view of my friend from Georgia that CDFIs and MDIs are included in this bill in the base text as a part of the study on how they can deliver effectively and have regulatory relief and regulatory direction in Mr. Norman's intended study. And I just would add as a footnote, since I opened this discussion talking about my own work in rural Arkansas in 2 very small agricultural counties, that one of those locations that I had in my company before I was in Congress, it's now operated by Arkansas's largest CDFI in that county, and they're doing quite a good job. So with that, I urge our members to oppose this amendment, and I yield back the balance of my time. Is there any further debate? Question now occurs on the amendment. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed signify by saying nay. Nay. In the opinion of the chair, the nays have it. The nays have it, and the amendment is not adopted. We'll now move on to the next amendment. Is there an additional amendment on Mr. Norman's ANS? Seeing no further amendments without objection, the previous question on the substitute is ordered. and recorded votes on the pending amendment have been postponed. Once these votes are taken, the committee will immediately vote on the adoption of the amendment in the nature of substitute and then consider the question to report the measure. We'll now move to the next bill. Pursuant to notice, I call up H.R. 6547, the Least Cost Exception Act, which was introduced by the gentleman from Nebraska, Mr. Flood. The clerk will report the bill, which was distributed in advance.
H.R. 6547, to amend the Federal Deposit Insurance Act to provide an exemption to the least cost resolution requirement and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. Representative Flood has an amendment in the nature of a substitute, copies of which have been distributed in advance. The clerk will report that amendment.
An amendment in the nature of a substitute to H.R. 6547, offered by Mr. Flood of Nebraska, designated as Flood 028.
Without objection, the amendment is considered read and will serve as base text for the purposes of amendment. The gentleman from Nebraska, Mr. Flood, the chair of our Housing and Insurance Subcommittee, is recognized to describe his amendment. You're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you and Ranking Member Waters for your work on housing. It's been a joy to work with Mr. Cleaver from Kansas City. The American people are seeing what it looks like when Congress functions the way it was intended, with bipartisan solutions to some of our toughest issues. On this legislation, I want to thank my co-lead, Congressman Bill Foster, who is also the ranking member of our Financial Institutions Subcommittee. This bill makes key reforms to the way the FDIC considers bids for a failing financial institution. As it stands currently, the FDIC must pursue, quote-unquote, the least cost resolution in the event of a bank failure. The least cost resolution requires the FDIC to take action that is least costly to the Deposit Insurance Fund of all of its available options in the event of an insured depository institution being at risk of default. The least cost resolution is often good and the best policy. We certainly want to protect the Deposit Insurance Fund when possible. However, there are situations where there is a compelling public policy case for the FDIC to choose an option that is not necessarily the least costly to the DIF. Specifically, this bill would allow the FDIC to select an alternative method to handle a failing financial institution if the FDIC and the Federal Reserve Board of Governors, in consultation with the Department of Treasury, determine that the potential costs to the Deposit Insurance Fund are outweighed by the benefits of limiting further concentration in the U.S. banking system. In the last 15 years, we have seen a notable decline in the number of financial institutions in the United States. According to the FDIC, we went from 6,519 banks in 2010 to 3,928 in 2024. That's a 39.7% decrease. This consolidation is driven by factors we've discussed at length in this committee and our subcommittee this year. For example, lots of new regulation has driven mergers and acquisitions, and less de novos have failed to backfill this gap. However, another factor that we must consider as it relates to the consolidation of what happens when a bank fails, as several did in 2023. If a very large institution is a bidder for a failing bank, under current law, the FDIC must select their bid if it's the least cost resolution for the Deposit Insurance Fund. That's exactly what happened with First Republic Bank back in May of 2023, when the FDIC selected JP Morgan Chase as the winning bid for the roughly $229 billion institution. To be clear, I don't know what the other bids were in play for First Republic, and I'm not personally qualified to assess the validity of competing bids in the event of a bank failure. That being said, I think it's entirely fair for us to say that the FDIC should take into account further concentration in the banking system when evaluating bids for a failed institution. In the event of a bank failure, we need to provide the FDIC with flexibility to evaluate bids from smaller institutions as long as there are guardrails in place to limit any additional cost to the Deposit Insurance Fund. So allow me just a moment to describe some of those guardrails in this bill. A competing bid to the least cost resolution must be the least costly of all the alternatives, and it must exceed the cost of liquidating the troubled depository institution. Number two, the FDIC will be tasked with completing a rulemaking on the maximum cost an alternative bid can pose to the DIF, and once that threshold is set, A bid cannot be selected if it goes above the threshold set by that rulemaking. 3, finally, if a bid is not the lowest cost bid and it's selected, the smaller institution must agree upon a plan to pay the difference between the cost of the bids back to the FDIC. This legislation is a thoughtful, balanced proposal that provides the FDIC with the flexibility needed to assess bids for failing institutions in a way that properly evaluate their quality, cost to the deposit insurance fund, and the broader implications for the banking sector. I urge my colleagues on this committee to support this legislation, and I yield back.
The author yields back. Who seeks recognition on Mr. Flood's A&S? Ranking Member, Ms. Waters, you're recognized.
Thank you very much. I move to strike the last
You're
word.
recognized for 5 minutes.
One of the issues that emerged from the regional bank failures 2 years ago was that the current procedures for bidding for failing banks is biased toward the biggest banks winning these bids, since the FDIC is required by law to go with the bid that poses the least cost to the deposit insurance fund. This approach ignores other policy issues, like concerns regarding how big megabanks can grow through acquisitions of failing banks and how that affects competition to the detriment of consumers. Moreover, our largest banks are subject to a concentration limit when they hold more than 10% of total deposits in the United States, and this limits them from acquiring another bank. However, there is a big exception that allows them to buy a bank if it is failing. While other entities made bids several years ago to buy First Republic Bank when it failed, our largest bank, J.P. Morgan Chase, won the bid and became even larger. And so I'm glad we're considering several bills to address this problem, including this one and another bill from Congressman Lynch. I want to thank the bill's sponsor, as the chairman and his staff, working with us to make improvements to ensure the bill creates a viable path for other banks to win these bids in the future when they compete with global systemically important banks, or GSIBs. So one of the changes will help ensure the FDIC can take into account a variety of factors, including any gaming of the bidding process by a GSIB, to ensure they don't force another bank to pay an unfairly high assessment. With these changes, I will support the bill. Now, ladies and gentlemen, I consider this legislating. I consider this is the kind of effort that we could make in so many ways to straighten out what the systems in the past have created, uncreate them, do away with them, and do what makes good sense, particularly when you're talking about stopping the concentration of big banks being able to acquire failing banks. Let banks who want to provide the services, who want to work with the community, who know the businessmen and women in their communities and what they need in way of capital, and prepared to help them out. This is good legislating. I'm happy to support this bill.
The gentlewoman yields back. Who seeks recognition on Mr. Flood's amendment in the nature of substitute? Dr. Foster.
Move to strike the last word.
The gentleman from Illinois is recognized for 5 minutes.
Thank you, Mr. Chairman. And first, I'd like to thank Congressman Flood for his leadership on this important bill that provides appropriate flexibility for the FDIC's least cost test for the resolution of failing banks. I'm a proud co-sponsor of H.R. 6547, the Least Cost Exception Act, which allows the FDIC to waive a strict interpretation of the least cost resolution requirement if banking regulators jointly determine that reasonable risk should be taken to the FDIC's Deposit Insurance Fund, or DIF, as part of an effort to limit further market concentration among the globally systemic important banks, or GSIBs. This will provide non-GSIB banks with greater flexibility when making their bids to allow them to better compete with GSIB banks that are typically much larger in terms of asset size. Firms that take advantage of this flexibility must meet certain requirements, including being willing to pay the difference between their bid and that of the of a GSIB, subject to potential discounts and other criteria that will be established by the FDIC under rules required by this legislation. And this committee will have to pay careful attention to those rules as they're promulgated. In recent years, members on both sides of this committee have agreed that we should do more to support banks of all sizes. Our barbell banking system, where too big to fail banks grow and bigger and the smaller banks stay small, is anti-competitive, and it creates a missing middle that leaves many consumers and businesses underserved. This includes working for reasonable regulatory reforms, like the flexibilities included in this bill, that support small, mid-size, and regional banks that have struggled to meet the current requirements placed on the resolution process. Specifically, following the 2023 regional banking crisis, my office heard concerns from stakeholders about JP Morgan Chase's acquisition of First Republic. In normal times, banks with more than 10% of total deposits in the United States are barred from acquiring another bank. However, that does not apply when they seek to acquire a failing bank. The additional flexibility provided by this bill will allow federal banking regulators to consider the impact to competition and the merits of further consolidation among GSIBs in the resolution process, giving them the flexibility to choose alternative bids that will promote a more competitive banking system and better serve the American public. So I thank Congressman Flood and Chairman Hill for working with Ranking Member Waters and myself to make adjustments to this bill to prevent the gaming of the bids by the largest banks and other worries that we had, to provide additional flexibility on the repayment terms provided to smaller banks, to minimize potential losses to the DIF and assessments on insured depository institutions. Smaller banks will be given a minimum of 5 years to match the least costly bid, or the amount determined appropriate by the banking regulators to support a sustainable acquisition and a healthy competition in the banking system. So I thank you all again for working with us on this legislation. Congressman Flood, I support this bill and encourage my colleagues to vote yes. Thank you, and I yield back.
Gentleman yields back. Who seeks recognition on Mr. Flood's amendment in nature of substitute? Seeing none, I'll recognize myself for 5 minutes. I support H.R. 6547, the Least Cost Exception Act offered by Mike Flood, our chair of our Subcommittee on Housing and Insurance. Established in 1991, the FDIC's least cost resolution mandate requires the agency to resolve failing banks by choosing the method that is least costly to the Deposit Insurance Fund, referred to as the DIF. We all understand that. At that time, I was working at the U.S. Treasury when that law was passed, and it was reflecting on the horrors of the 1980s on the open bank assistance, where the federal government went in and took a position in an open bank like Continental Illinois, for example, or other banks that failed during the 1980s, and most recently at that time, the failure of the thrift industry across the country, where there were significant costs to the FSLIC, the insurance fund for thrifts. So it was a natural reaction that the federal government wanted to minimize those costs associated with resolving banks. But what's happened over the 30 years since is that this issue of having adequate resources at the FDIC to do merger and acquisition analysis, do the work inside the office of the chairman and the office of resolutions there, that's deteriorated over the last 20 years. And this issue of the contrast that Ranking Member Waters talked about, which is we're willing to waive the 10% deposit cap on the largest institutions to be that least cost bidder versus considering another alternative. And so what we're going to have today are some smart ideas that give some additional tools to the Federal Reserve and the FDIC in considering resolution. And one is the one offered today that Mr. Flood and Mr. Foster have discussed, and I want to say I support it because the least cost mandate only I think has contributed to increased concentration in the U.S. banking sector among failed banks when they're resolved. Allowing greater flexibility to the FDIC's resolution process to consider a broader set of factors would better align its bid evaluations with the full weight of the economic impact of these transactions, rather than limiting the analysis by focusing exclusively on the cost to the DIF. This bill would accomplish this by modifying the least cost mandate to provide the FDIC with some discretion to approve a bid of a failed or failing bank other than the initial absolute least cost bid, provided certain conditions were met. This preserves the existing least cost resolution framework in most cases and maintains the possibility for large bank bids when there's simply no other bidders, but provides the FDIC with flexibility to consider factors addition to cost when there's an alternative competitive bid. Importantly, the bill does not contradict the FDIC's mission to protect depositors for failed banks because it offers the recoupment of that gap in the name of competition. And as I say, this is part of a series of measures today that reflect on this and measures that this committee has already marked up, such as offering the idea of a shelf registration, offering the FDIC the ability to have outside investors partner with banks in the case of a failure, and as I say, make a more robust team of experts at the FDIC that understand merger and acquisition and failed bank resolution economics. All those things are important, and we'll hear from Mr. Lynch's bill a bit later today as well. So I urge members to vote yes. I thank Mr. Flood and Foster for this targeted reform, and I yield back the balance of my time. Anyone else seek recognition on the amendment in nature of a substitute? Hearing none, we'll move to amendments. Is there an amendment to the bill? If no amendments, there being no discussion or amendments on the bill, the question now occurs on the adoption amendment in the nature of a substitute. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The amendment is adopted. The question now occurs on ordering the bill as amended to be reported to the House with a favorable recommendation. All those in favor, please signify by saying aye. 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 All those opposed signify by saying nay. Opinion of the chair, the ayes have it. For what purpose does the gentleman from Nebraska seek recognition?
Mr. Chair, I'd ask for a recorded vote.
A recorded vote is requested. All those in favor of recorded vote, raise your hands. A sufficient number having raised their hand, a recorded vote is so ordered. Pursuant to subsection C5 of Rule 3, the committee rules, the vote on this question is postponed. We'll now move to our next bill. Pursuant to notice, I call up H.R. 6555, the Enhancing Bank Resolution and Participation Act, which was introduced by the committee's vice chairman, Mr. Heisinger of Michigan. The clerk will report the bill, which was distributed in advance.
H.R. 6555, to require the Comptroller of the Currency and the Federal Deposit Insurance Corporation to carry out a study on shelf charters and modified bidder qualification processes and for other purposes.
Without objection, the bill is considered read and open to amendment at any time. Representative Heisinger has an amendment in the nature of a substitute, copies of which have been distributed in advance. The clerk will report the amendment.
An amendment in the nature of a substitute to H.R. 6555, offered by Mr. Heisinger of Michigan, designated as Heisen 071.
Without objection, the amendment is considered read and will serve as base text for the purposes of amendment. The gentleman from Michigan, our vice chairman, is now recognized to describe his amendment for 5 minutes.
Thank you, Mr. Chairman Hill. During the spring of 2023, it quickly became clear that regulators were unprepared to deal with another bank crisis. The lack of timely resolution sent deposit outflows to the largest of the banks in the country, temporarily creating uncertainty in U.S. markets. While many of those community financial institutions saw much of those deposits return, the uncertainty of banking regulators to respond decisively created unnecessary pain, confusion, and frankly, risk. Under the Federal Deposit Insurance Act, the FDIC is charged with resolving failed banks and protecting insured deposits in a manner that is, quote, least costly to the deposit insurance fund, close quote. In 1991, to deal with the savings and loan crisis, Congress passed the Federal Deposit Insurance Corporation Improvement Act, which established the least cost resolution, the LCR, mandate. The LCR, as one would assume, requires the FDIC to resolve failed banks by choosing the method that costs the deposit insurance fund the least amount of money. As part of the response to the great financial crisis, Congress gave the FDIC another tool when it created the Orderly Liquidation Authority. The OLA, again, as one would assume, allowed the corporation to manage and quickly liquidate a large failing financial company. My bill, the Enhancing Bank Resolution Participation Act, potentially gives the federal banking agencies yet another logical tool when faced with resolving a failing financial institution. Mr. Chairman, in bank failure scenarios, regulators should have a wide range of institutions lined up to bid on a failed bank, increasing the proceeds received by the FDIC and lowering the potential costs to the Deposit Insurance Fund. H.R. 6555 directs the federal banking agencies to jointly study the use and benefits of granting something called a shelf charter, a modified bidder qualification process to increase participation in the bank resolution process. Shelf charters are exactly as they sound, a conditionally approved but inactive national bank charter that allows non-bank investors to quickly acquire and operate failed or troubled banks from the FDIC during a crisis. Importantly, the bill also asks the OCC and the FDIC to examine the use of shelf charters and a modified bidder qualification process since January 1 of 2008, as well whether each were considered or used in connection with the failed banks of 2023. Based on this committee's investigation into the 2023 bank crisis, which I had the honor of leading that investigation as chair of the Oversight and Investigation Subcommittee, we know private capital was not considered. Lastly, the bill attempts to support the work with the FDIC and that the FDIC and the OCC are already working on. Earlier this year, the FDIC announced they developed a seller financing program for non-bank bidders to increase competition by including private firms and other non-bank entities. In his testimony before the committee 2 weeks ago, Acting Chair Hill, that's Travis Hill, don't worry, Mr. Chairman, confirmed his desire to see greater participation. To quote the acting chair, the FDIC wants to, quote, facilitate more and better and lower cost bids and to bring more capital into the bidding process. The objective is to A, reduce the cost of the DIF to the DIF, and B, increase the likelihood of stabilizing transaction options in the event of large failures, close quote. Mr. Chairman, we can all agree that limiting taxpayer exposure while strengthening consumer confidence in our banking system should be our end goal. This bill does that. And I want to thank my friend from New Jersey, Mr. Gottheimer, for sponsoring this bill, and I believe that this is a very good, positive, strong first step. And with that, I yield back.
Gentleman yields back. Who seeks recognition?
Yes.
Gentlewoman from California.
I move to strike the last word.
Gentlewoman's recognized for 5 minutes.
This is another study bill that we are considering today. I'm not big on a lot of study bills. I think what you're studying, you should just go ahead and accomplish because you know what the problem is. With this one, focus on trying to encourage more entities to bid for failing banks through use of something called shelf charters. Shelf charters are temporary charters set up by the Office of the Comptroller of the Currency to allow non-bank investors that are otherwise prohibited from owning FDIC-insured deposits to bid on failing banks. I'm open to exploring these alternatives. I appreciate that the revised bill will consider how non-bank entities that buy banks affect the acquired bank safety and soundness and the availability of products and services provided to the consumers. I yield back the balance of my time.
I thank the gentlewoman. She yields back. Is there further debate? I'll recognize myself for 5 minutes. I support H.R. 6555, Enhancing Bank Resolution Participation Act, offered by my good friend, the Vice Chairman. During the financial crisis, federal regulators developed a process allowing other non-banks to establish a bridge bank known as a shelf charter, specifically to participate in failed bank transactions. I noted in my previous comments on Mr. Flood's bill how it's important for the FDIC to have expertise, resident in-house expertise, on contract expertise to consult on resolution process. But it's also important they have additional tools, and we want the FDIC to understand that and make recommendations to us on how the bank resolution process can be enhanced by attracting new sources of capital and bidders into this process. And so I thank the gentleman from Michigan for his work on this bill. Typically, a bank resolution process culminates in a purchase and assumption agreement. And since only insured depository institutions are legally allowed to assume bank liabilities like deposits, non-banks may only bid on a failed asset or failed bank's asset side of their balance sheet, while chartered banks may participate in the FDIC's purchase and assumption auction. Inexplicably, these tools were not used when the agencies attempted to resolve the 2023 bank failures, which I believe, if they had been in place, the debate we're having today, it would have helped them have a much better, more smooth resolution process in 2023, including expanding the pool of qualified bidders that were able to participate and have a more competitive bid process. This bill simply directs the federal banking agencies to study the use and benefits of granting self-charters and modifying bidder qualification process. They'll bring that important information back to this chamber and this House for our consideration on if there is statutory changes that need to be made. This will ensure our regulators are considering how to improve the efficiency of their operations and the critical importance of the bank resolution framework. I want to thank Mr. Heisinger for his work in introducing this bill, encourage all of our members to support it, and I yield back. Does anyone else seek recognition on the Vice Chairman's ANS? Hearing none, we'll move to amendments. Does anyone have an amendment on this measure? Seeing no further discussion or amendments on the bill, question now occurs on the adoption amendment in the nature of a substitute. All those in favor signify by saying aye. Aye. All those opposed signify by saying nay. In the opinion of the chair, the ayes have it, and the amendment is adopted. The question now occurs on ordering the bill as amended to be reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. Opinion of the chair, the ayes have it. For what purpose does the gentleman from Michigan seek recognition?
Mr. Chairman, I request a recorded vote.
Gentleman requests a recorded vote. All those in favor of recorded vote, raise your hands. A sufficient number having raised their hand, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, a vote on this question is postponed. We'll now move to the next bill. Pursuant to the previous order, the chair declares the committee in recess. Subject to the call, the chair will reconvene at 12:15. Committee will come to order following our recess. Pursuant to notice I call H.R. 6556, the Failing Bank Acquisition Fairness Act, which was introduced by Representative Lynch of Massachusetts, the ranking member of our Financial Technology Subcommittee. The clerk will report the bill, which was distributed in advance.
H.R. 6556, to prohibit the use of certain concentration limit exceptions with respect to mergers involving a failed bank unless the applicable agency determines such use is necessary to prevent significant economic disruption or significant adverse effects on financial stability and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. Representative Lynch has an amendment in the nature of a substitute, copies of which have been distributed in advance. The clerk will report this amendment.
An amendment in the nature of a substitute to H.R. 6556, offered by Mr. Lynch of Massachusetts, designated as Lynch 050.
Without objection, the amendment will be considered read and will serve as the base text for purposes of amendment. The gentleman from Massachusetts, Mr. Lynch, is recognized for 5 minutes on his amendment.
Thank you very much, Mr. Chairman, and to the ranking member and our very capable staff for including this legislation on today's markup calendar. The Failing Bank Acquisition Fairness Act will address the exception that allows a mega bank with more than 10% of total deposits in the U.S. to acquire a failing bank. Specifically, my bill will prevent mega banks from bidding for a failed bank if there are other eligible bids from well-capitalized and well-managed small and mid-sized banks. The Regal-Neal Act of 1994 established the 10% nationwide depository cap, along with the exemption for the acquisition of failing banks. In the 3 decades since 1994, the number of commercial banks in the United States has declined by approximately 50%, a continuation of the dangerous trend of consolidation, which has predominantly occurred among the largest financial institutions in this country. Most recently, the collapse of First Republic, Silicon Valley Bank, and Signature Bank in 2023, which were the second, third, and fourth largest bank failures in our history, resulted in J.P. Morgan Chase acquiring First Republic and its nearly $230 billion in assets. According to the Wall Street Journal, and I quote, "Federal regulators wanted a strong deal for the First Republic Bank. As a result, they helped America's largest lender get even bigger." The Journal went on to say that regulator concerns regarding big bank consolidation seem to be, quote, "set aside," a recognition that the largest lenders possess unmatched firepower to step in during times of financial distress, close quote. While multiple smaller bidders also sought to acquire First Republic, J.P. Morgan Chase, with more than $4 trillion in assets, effectively won the government auction and then quickly announced plans to shut down 1/4 of First Republic's 84 branches at the expense of depositors who were left without a local branch, and of course the approximately 1,000 employees who were then laid off. In the wake of this acquisition, consumer advocacy organizations such as Americans for Financial Reform and Better Markets raised serious concerns about the advantages afforded to large, interconnected financial institutions like J.P. Morgan Chase in bidding for failing banks. To that end, I introduced this legislation, which, if it had been in law at the time, would have prevented J.P. Morgan Chase from acquiring First Republic. The consolidation of our banking system introduces systemic risk and reduces the resilience of our financial system in the face of an economic shock. This legislation would take an important step in combating the pace of consolidation by preventing mega banks from taking advantage of financial crises to gobble up their competitors and to pad their own profits. I'm proud to have the support of the Americans for Financial Reform on this bill, and I urge my colleagues on both sides of the aisle to support this legislation. And in closing, I would like to ask unanimous consent to enter into the record an article from Better Markets, the title of which is "Jamie Dimon is Still Dancing in the Streets 1 year after J.P. Morgan Chase's acquisition of First Republic Bank." With that, Mr. Chairman, I yield back the balance of my time.
Without objection, that'll be included in the record, and the gentleman yields back. Who seeks recognition on Mr. Lynch's amendment in the nature of substitute? Not seeing other speakers, I'll recognize myself for 5 minutes. I support H.R. 6556, the Failing Bank Acquisition Fairness Act, and I want to thank Steve Lynch for engaging with our team on financial services and the majority on this important bill. This committee has held several hearings this Congress examining the federal government's role in the concerning trend of consolidation in the banking industry. While new bank formation and merger and acquisition activity tend to ebb and flow with trends in the broader economy, the banking industry still has not fully recovered from the overcorrection experienced in the provisions of Dodd-Frank. Under current law, there are 5 major concentration limits that prohibit federal regulators from approving a merger and acquisition of a failed or failing bank if the resulting institution would control more than 10% or more of the national deposits. This bill limits the circumstances in which the federal banking agencies can waive these concentration limits for transactions in which there are no other qualified bidders for the failed bank, and the transaction is necessary to prevent significant economic disruption or adverse effects on financial stability. This bill gives the regulatory agencies flexibility to consider a greater number of competitive bids, especially for smaller institutions. This bill also includes critical safeguards, which are a requirement for the regulators to submit a report to Congress within 30 days of waiving the concentration limit, including the justification for that waiver, a description of alternate bids for that our outcomes consider, an explanation of why alternative bids were not selected, and any recommendations for legislative or regulatory changes to improve competition in future bank resolutions. Together, this bill offers regulators the necessary flexibility when considering competitive bids for failed or failing banks while ensuring accountability to Congress. I'm proud to support this bill alongside the other work in the bank resolution space that we've talked about today, and I encourage all members of the committee to support this bill as well. I thank the gentleman from Massachusetts, and I yield back. Does anyone else seek recognition on the A&S? Hearing none, we'll move to amendments. Does anyone wish to offer an amendment to Mr. Lynch's A&S? Hearing no further discussion or seeing any amendments to the gentleman's bill, the question now occurs on the adoption of the amendment in the nature of a substitute. All those in favor, please say aye.
Aye.
All those opposed signify by saying nay. In the opinion of the chair, the ayes have it, and the amendment is adopted. The question now occurs on ordering the bill as amended to be reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. In the opinion of the chair, the ayes have it.
Mr. Chairman, I request a call the yeas and nays.
Gentleman from Massachusetts requests a recorded vote. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. The vote on this question is postponed. We'll now move to the next measure. You bet. Thank you. Pursuant to notice, I call up H.R. 6554, the Community Bank Representation Act, which was introduced by the distinguished Congresswoman from South Texas, Representative De La Cruz. Clerk will report the bill that was distributed in advance.
H.R. 6554, to amend the Federal Reserve Act to specify additional responsibilities of the member of the Board of Governors of the Federal Reserve System who was appointed as the member with experience working in or supervising community banks and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. Representative De La Cruz has an amendment in the nature of a substitute, copies of which have been distributed in advance. The clerk will report that amendment.
An amendment in the nature of a substitute to H.R. 6554, offered by Ms. De La Cruz of Texas, designated as Dela CR 056.
Without objection, the amendment is considered read and will serve as base text for the purposes of amendment. The gentlelady from Texas, Ms. De La Cruz, is recognized for 5 minutes.
Thank you, Mr. Chairman, for bringing up my bill, H.R. 6554, the Community Bank Representation Act. This important piece of legislation ensures that the community bank representative on the Federal Reserve Board has a strong voice in the supervisory and regulatory decisions impacting the 3,300 plus community banks the FRB supervises. As a former small business owner, I know just how vital our community banks are. They are the pillars of our community and often the lifelines that spur economic growth and job creation. Since 2014, the Federal Reserve Board of Governors has been required to have at least one member with primary experience relating to community banking. This important addition was a bipartisan decision that Congress made to ensure the FRB's governance structure supports informed decision-making specific to the needs of community banks. H.R. 6554 builds off this by strengthening the community bank representative's voice. Specifically, the Community Bank Representation Act makes clear that the community bank representative on the HRB should develop policy recommendations and oversee the supervision and regulation of community banks, while still working with the vice chair for supervision and any other FRB members with community banking experience. Importantly, this bill ensures that community bank representative, if different from the vice chair of supervision, would come before Congress at semi-annual hearings to outline supervisory and regulatory actions impacting our community banks. H.R. 6554 also updates the asset threshold relating to the community bank representative in perpetuity by indexing it to nominal GDP and ensuring the FRB member on the FFIEC consults with the community bank representative on cross-governmental decisions impacting the sector. The Community Bank Representation Act strengthens congressional intent for the Federal Reserve Board's community bank representative, and I urge my colleagues to join me in supporting it. Thank you. I yield back.
Gentlewoman yields back. Who seeks recognition on the gentlewoman's amendment in nature of substitute?
Green from Texas, Mr. Chairman.
Mr. Green, you're recognized.
Thank you, Mr. Chairman. Mr. Chairman, I move to strike the last word.
You're recognized for 5 minutes.
I appreciate the efforts to support our community banks, but this bill is an odd way to accomplish that objective, especially at a time when the president is doing all that he can to undermine the independence of the Fed. From his repeated attacks on Chair Powell to his unlawful attempt to fire Governor Cook. We already have a complicated regulatory system with not one or two, but 3 federal banking regulators. Instead of simplifying things, this bill would complicate the situation by splitting supervision and regulatory duties at the Federal Reserve, taking away community bank regulation and supervision duties. Congress gave the Fed's vice chair of supervision and having another person handle these duties. While the vice chair of supervision would continue to be nominated by the president and confirmed by the Senate, this new community bank official would not. They could not have 2 radically different approaches to supervision that would not have been, that will not have to be reconciled, that will not be reconciled, excuse me. Furthermore, I find it odd that House Republicans want to require another official to testify before the committee, but have completely failed to abide by statutory requirements to have other officials testify, most notably CFPB Acting Director Russell Vaught. Instead of adding more testimony requirements, let's start by holding the CFPB acting director accountable for his harmful actions to undermine the will of Congress and shut down the agency that, until his appointment, secured more than $21 billion for more than 105 million consumers harmed by financial institutions. Moreover, we should scrutinize the unlevel playing field that Republicans have left for community banks since the CFPB is no longer supervising the biggest competitors for consumer compliance, specifically mega banks and big tech payment apps. I urge members to oppose this bill, and I yield back.
Gentleman yields back. Who seeks recognition on the gentlewoman's amendment in the nature of a substitute? Seeing no other discussion, I'll recognize myself for 5 minutes. I support H.R. 6554, the Community Bank Representation Act, as introduced by Representative De La Cruz of Texas. This bill ensures community banks have true representation on the Federal Reserve Board by formalizing the role of the community bank representative. And I know all of our members know that we have a community bank representative as a governor on the Fed board. In overwhelmingly bipartisan fashion in 2014, Congress took the step to require at least one member of the Federal Reserve Board to demonstrate that primary experience in working in or supervising community banks. However, the specific role of community bank resolution in overseeing and regulating community banks was never clearly defined, even though the vast majority of banking organizations that the Fed oversees are those community banks. That's why my Making Community Banking Great Again principles last year highlighted the need to strengthen the role of the community bank representative, so that when the board conducts supervision and crafts regulations that affect community banks, it hears directly from the governor with real community bank experience. This bill delivers that clarity and ensures the community bank representative takes a lead role in the supervision of community banks. Currently, only the vice chair for supervision is given a statutory role in overseeing supervision and regulation of the Federal Reserve Board, including policy recommendations to the board and testifying twice a year before House Financial Services and Senate Banking Committees on the Fed's supervisory program. Yet the vice chair of supervision may lack the necessary experience to understand the unique challenges that our community banks face. This bill takes the important step of ensuring the community bank representative works with the vice chair to issue policy recommendations to the full board on the supervision and regulation of community banks. It also ensures that the Congress will get to hear semi-annually from community bank representative on the supervision and regulation of community banks as well. That will increase the visibility on this important role that the Fed plays and provide Congress the opportunity that it can hold the Fed accountable for balancing their important role of supervision of banks of all sizes. I urge members to support this legislation, and I yield back the balance of my time. Who else seeks recognition on the amendment in the nature of a substitute? Hearing none, we'll move to amendments. Is there an amendment to Ms. De La Cruz's bill? Hearing no further discussion and no additional amendments offered on the ANS, the question now occurs on adoption of the amendment in the nature of a substitute. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. Nay. In the chair, the ayes have it, and the amendment is adopted. The question now occurs on ordering the bill as amended to be reported
Mr.
to
Chair.
the House. Just a moment, gentlewoman. The question now occurs on ordering the bill as amended to be reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. Nay. In the opinion of the chair, the ayes have it. For what purpose does the gentleman from Texas seek recognition?
Mr. Chair, I would like to request a recorded vote.
A recorded vote has been requested. All those in favor of recorded vote, raise your hands. A sufficient number having raised their hand, recorded vote is so ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. We'll now move to the next measure. Pursuant to notice, I call up H.R. 6550, the American First Act of 2025, which was introduced by Representative Loudermilk of Georgia. The clerk will report the bill, which was distributed in advance.
H.R. 6550 to require annual reporting on interactions between federal banking supervisory agencies and global financial regulatory or supervisory forums and for other purposes.
Without objection, the bill is considered read, open to amendment at any point. Representative Loudermilk has an amendment in the nature of a substitute, copies of which have been distributed in advance. The clerk will report that amendment.
An amendment in the nature of a substitute to H.R. 6550 offered by Mr. Loudermilk of Georgia, designated as Louder 028.
Without objection, the amendment is considered read and will serve as base text. For the purposes of amendment, the gentleman from Georgia, Mr. Loudermilk, you're now recognized for 5 minutes to discuss your amendment.
Well, thank you, Mr. Chairman. I speak today in support of my bill, H.R. 6550, the America First Act. My bill would simply require the Federal Reserve Board, Office of the Comptroller of the Currency, and the FDIC to include their interactions with global financial regulatory or supervisory forums like the Basel Committee on Banking Supervision in their annual reports to Congress. This bill would ensure accountability to Congress and to the American people. As part of their congressionally authorized duties, federal financial regulators must sometimes engage with foreign counterparts due to interconnectedness of global financial systems. However, the outcome of these interactions are non-binding agreements that reflect partisan priorities and impose domestic regulations under the guise of international cooperation. Federal financial regulators are bound by U.S. laws and cannot and should not be permitted to commit the American people to international agreements or frameworks without transparency and congressional oversight. This is not a radical proposal. H.R. 6550 would not have any impact on the federal regulators' abilities to meet with their counterparts, negotiate, and provide their insights. It will not interfere with the constitutional role of the executive branch in conducting international negotiations. Instead, it will simply require that Congress is given a transparent accounting of these interactions instead of being left in the dark while regulators make binding policy agreements that may or may not have the American people's best interest in mind. During the Biden administration, we saw America's banking regulators push highly partisan environmental, social, and governance policies, reversing long-standing efforts to be objective. The America First Act will continue the work to depoliticize banking regulations, remove unnecessary political influence from the financial supervisory regime, and restore transparency and accountability to our financial system. This is a common sense bill that ensures our prudential regulators are putting the American people first and their interests first when interacting with global governance bodies. Transparency here is essential and should not be controversial. I urge my colleagues to support the bill, and I yield back.
Gentleman yields back. Who seeks recognition?
Green from Texas, Mr.
Mr. Green
Chairman.
from Texas, you're recognized.
I move to strike the last word.
Recognized for 5 minutes.
While the sponsor of this bill may have entitled it America First, the bill's approach will put America last when it comes to undermining the U.S. regulators working through international coordinating bodies. It is imperative that we support efforts by our regulators to collaborate with foreign counterparts to address real threats to financial stability, like climate-related risk, and otherwise advance U.S. interests in forums like the Financial Stability Board and Basel Committee. This bill ignores that Congress gets regular updates from these agencies about international work in their annual reports and when we have their leaders testify before the committee. Unfortunately, this bill has such extensive reporting requirements that it will likely chill candid conversations that our regulators should be having in these forums. Moreover, if Republicans want to put America first, then why have done little to hold the administration accountable for their $40 billion bailout of Argentina while the U.S. government has shut down? Where is their bill to require extensive reporting of that deal, which puts U.S. taxpayers at risk? I urge members to oppose this misguided bill, and I yield back.
Gentleman yields back. Seeks recognition. Gentleman from Tennessee.
I move to strike the last word.
Gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. I move, the American Financial Institution Regulatory Sovereignty and Transparency Act, or the America First Act, American First Act, addresses a critical gap in congressional oversight of our financial regulatory system. For too long, our federal banking agencies have participated in international forums like the Basel Committee, the Financial Stability Board, the Bank for International Settlements, and the Network for Greening the Financial System with minimal transparency to Congress and the American people. These forums make recommendations that often become the basis for regulations affecting every bank, credit union, and financial institution in this country. Yet Congress has had limited visibility into how our regulators engage with these bodies, what positions they take on behalf of the United States, and how international agreements translate into domestic policy that impacts Main Street businesses and consumers. The consequences are real. When Basel III capital requirements were negotiated internationally, American community banks and regional institutions faced compliance burdens that their foreign competitors did not. When the Financial Stability Board discusses systemic risk frameworks, those discussions can result in regulations that affect lending in Tennessee and across rural America. The American First Act changes that by requiring comprehensive transparency. This bill requires the Federal Reserve Board, the Office of the Comptroller of the Currency, and the Federal Deposit Insurance Corporation to provide detailed information in their annual reports on their interactions with global financial regulatory forums. This information must include which forums our regulators participate in, what positions they take on behalf of the United States, what policies are being adopted, and most importantly, economic impact analyses showing that implementation costs are justified by real benefits to American economic interest, national security, or financial stability. Additionally, the bill expands the Federal Reserve's existing biannual testimony requirement before this committee to include detailed reporting on these international engagements. This is about accountability and, yes, sovereignty. When international bodies recommend capital requirements, liquidity standards, or climate-related disclosures that become regulations, the American people and Tennesseans deserve to know how these recommendations become binding on their local communities. They deserve to know whether the costs imposed serve American economic interest or simply check boxes for international bureaucrats who have never set foot in Tennessee's 6th congressional district. Congress holds the constitutional authority over financial regulation in this country. Our financial regulators work for the American people and answer to this Congress, not to unelected officials in Basel, Switzerland. The American First Act ensures that principle applies even when they sit at international tables making decisions that affect American financial institutions and the families and businesses that they serve. I thank my colleague, Mr. Loudermilk, for introducing this important legislation, which I have agreed to co-sponsor, and I urge my colleagues to join me in supporting this common sense transparency measure. With that, Mr. Chairman, I yield back the balance of my time.
The gentleman yields back who seeks recognition. Gentleman from Nebraska, the chairman of our Housing and Insurance Committee, Mr. Flood.
Yes, Mr. Chairman, I move to strike the last word.
You're recognized for 5 minutes.
Thank you, Mr. Chairman. I support the American Financial Institution Regulatory Sovereignty and Transparency Act sponsored by Representative Loudermilk, and I am proud to be an original co-sponsor of the legislation. This bill includes a series of common sense provisions that would give Congress and the American people more insight into our regulators' interactions with global financial, regulatory, and supervisory forums. Among other things, components of my legislation from last Congress, the International Transparency and Accountability Act, is included in this bill. We all know the weight that decisions made by international bodies can have on America's own laws and regulations. For example, the Basel III Endgame proposal from the last administration, which derived from negotiations at the Basel Committee on Banking Supervision, would have significantly increased capital requirements for our financial institutions and likely had knock-on effects on our entire economy. The Federal Reserve joined the Network for Greening the Financial System in 2020. NGFS focuses on setting climate goals and the integration of climate-related risks into financial stability monitoring and supervision, end quote. The Federal Reserve seemed to take inspiration from its membership in NGFS, and it launched a pilot climate stress test scenario in 2023. The Federal Reserve Board withdrew from NGFS early this year, and it appears the climate stress tests have stopped as well. Let me be clear. Our view is not that we should forbid our regulators from engaging with all international regulatory bodies. That's not it at all. I'm sure in some cases these multinational organizations can be helpful to our regulators. But there needs to be some transparency, just like how there are rules associated with public reporting on formal meetings of the Federal Reserve Board of Governors. There need to be similar standards if those same officials engage overseas. Congress and the American people deserve to know what positions our regulators are taking on our behalf during these meetings, particularly when those decisions could have broad, sweeping effects on U.S. policy at home. I support the bill. I thank Representative Loudermilk and his leadership and urge my colleagues to vote yes. With that, I yield back.
Gentleman yields back, who seeks recognition. Chairman of our Subcommittee on Financial Institutions, Mr. Barr, you're recognized.
I move to strike the last word.
Gentleman's recognized for 5 minutes.
Thank you, Mr. Chairman, and I want to thank my good friend, Mr. Loudermilk, for introducing this legislation, the America First Act. I'm proud to be an original co-sponsor of this legislation, and I would just note that versions of this legislation have been introduced in prior terms of Congress, especially last term of Congress, where we saw the abuse of Biden-era regulators going to these international governance bodies, entering into agreements and then not reporting back to the Congress, binding American regulators without fulsome consultation with the American people and the representatives in Congress. And Mr. Loudermilk, I think, has consolidated a lot of those ideas and improved those pieces of legislation into a product that we can all be proud of. The bill reflects the bipartisan recognition that our federal financial regulators need to provide greater transparency and accountability when engaging with international fora. And Mr. Rose and Mr. Flood made these arguments very well. I can't improve on the arguments that they made, but I would just note that last Congress, this committee held several hearings about the lack of transparency that does exist between global governance bodies and federal financial regulators. We also examined how participation in such discussions resulted in rulemakings that would have put American financial institutions at a competitive disadvantage compared to their global counterparts. And that's really the point here. The point is that while there may be some value in cross-border deliberations, there may be some value in international engagement. I actually led a bipartisan congressional delegation to Basel, Switzerland. I see my friend Mr. Kasten joined us on that. Mr. Foster joined us on that. There's some value in those discussions, but those discussions, whether from members of Congress or from regulators, should not be binding on the American people, and they certainly shouldn't be conducted in secret or with opacity. And the objective should never be international regulatory harmonization. That should never be. There's some utility in consultation with peer countries and other regulators. There's some value in that. But the goal should never be international harmonization. The goal should be American competitiveness. That's why this legislation is so correctly named the America First Act. The goal should be American economic growth. We should want better regulation than other parts of the world. And that's to the benefit of the American people. We can never allow federal regulators to export their responsibilities to foreign groups that are not represented by, not comprised of, nor accountable to the American people. This bill asserts American sovereignty. It requires the American banking agencies to report on their interactions in these forums in their annual reports, an important step toward increasing transparency and oversight. This is a common sense piece of legislation aimed at reaffirming Congress's oversight role over federal regulators. And I'll just say, you know, we did see the abuses especially prominent with the Network for the Greening of the Financial System, an attempt to import values antithetical to the United States into our own legal framework. Basel is another example, the Financial Stability Board, but we should not be importing rules that may be inconsistent with U.S. national interests. And a final point I'll make is in rebuttal to my friend, the gentleman from Texas, Mr. Green, who argues that this is America Last. It's not America Last. It's quite the opposite. We're not prohibiting, to be clear, this legislation does not prohibit American regulators from international engagement, participation at Basel or the FSB. It does not limit their ability to take positions before or negotiate with these international bodies. Instead, what the legislation does is it provide Congress, and after all, we are the Congress, we should be united in bipartisan unity here in defending the prerogatives of Congress, the lawmaking branch, with the needed transparency and oversight so that the American people are in charge, not the ivory tower central bankers and the foreign central bankers in Basel, Switzerland. The American people are in charge of our laws, and that's what this bill does. It restores sovereignty to the American people over the laws that govern them. And as we approach the 250th anniversary of the founding of this country and the Declaration of Independence, consent by the governed, that's what we're doing here today. I yield back.
Gentleman yields back, seeks recognition. Not seeing, Mr. Green, have you spoken? You have, yeah. So you want to speak on, okay. Not seeing anyone on the Loudermilk A&S, I'll recognize myself for 5 minutes. I want to just say I'm in support of H.R. 6550. I think it makes sense. I appreciate the comments that our excellent chair of our Financial Institutions Subcommittee makes, and I also appreciate him, along on a bipartisan basis, doing the kind of due diligence that this committee is well known for by going to Basel, Switzerland, and walking through capital standards. Personally, I support harmonization of capital standards and trying to minimize regulatory burden across the economies of the world. That's a good thing. But I think what Mr. Loudermilk has done an excellent job of is make sure that we're on the same page, that the representatives, the elected representatives of the people are aware of extraterritorial meetings being held on securities or banking or other regulatory burdens that do have impact, absolute impact on the domestic economy here and the growth of that economy and the burdens of compliance on our financial institutions. And I believe in the last administration, the Biden administration, this was a classic example. Representative Gonzalez and I were in Basel, Switzerland in August, and I just would echo Mr. Barr's comments in that when we were in a meeting about Basel III capital standards for our banks, they made it very clear, you didn't implement Basel III. You implemented Vice Chairman Barr of the Federal Reserve's version of Basel III. And that's exactly why I think we need this greater transparency, because if we were well aware of the parameters as a Financial Services Committee, Senate Banking Committee, of just what the goals of a harmonization effort on capital standards look like, we'd be a better judge and ask better questions of our own regulators, in this case the Federal Reserve Board, Vice Chairman of Supervision, Michael Barr, where in fact he was doing a lot more than was even required under Basel, and yet the Basel capital standards were not clear on what the goals were. So I think Mr. Loudermilk's bill brings some clarity to our oversight work and informs the American people that we're focused on. It's good to have harmonized standards, but we want to make sure those are done in a way that's consistent with economic growth here in America and balanced compliance and financial burdens on our financial institutions and our legal system, which is very different than legal systems and regulatory systems in other nations, including those of the other G6 countries and the G7. So I yield back the balance of my time. I urge a yes vote on the Loudermilk amendment. Who seeks recognition? Is there any more discussion? If not, we'll move to amendments. Is there an amendment to Mr. Loudermilk's bill? The gentleman from Illinois.
I have an amendment at the desk.
Gentleman has an amendment at the desk. We'll pause for its distribution. Gentleman from Georgia reserves a point of order. Clerk will report.
An amendment to the amendment in the nature of a substitute to H.R. 6550, offered by Mr. Caston of Illinois, designated as Caston 090.
Without objection, the amendment's considered read, and the gentleman from Illinois, Mr. Caston, you're now recognized for 5 minutes on your amendment.
Thank you, Mr. Chair. Number one, I share my colleagues' commitment to transparency and accountability in our financial regulators, and I certainly agree with Mr. Louderbilk. Concerns about political influence from our financial regime. To that end, I would suggest that the current administration owes the same level of disclosure to the public and to Congress about the Treasury Department's taxpayer-funded bailout of Argentina. This amendment would require the Federal Reserve to also provide detailed information about the terms and conditions of the financial package, or I should say packages, that have been provided to Argentina. I would remind everyone that earlier this year, President Trump committed more than $40 billion to prop up Argentina's economy. The timing of this was suspicious, coming right ahead of the country's October elections, given his open political support for President Javier Milei. The Treasury Department used the Exchange Stabilization Fund to establish a $20 billion swap line with Argentina's central bank and to directly purchase an unspecified number of Argentinian pesos. It was also subsequently reported that the administration was arranging an additional $20 billion private investment vehicle funded by some of the largest U.S. banks. I want to just point out for everybody, the Exchange Stabilization Fund was never intended to provide open-ended bailout financing for foreign governments or to purchase foreign currencies outright, at least certainly not without robust terms to ensure oversight and accountability. And given the volumes of the dollars here, even small percentage swings in the exchange rate of the peso are going to translate into hundreds of millions of dollars of losses for the fund and therefore potentially for American taxpayers. That's a small percentage swing. The Argentinian peso has lost more than 27% of its value against the peso this year. Every single one of us on this committee should care about that. The bailout for Argentina is also directly hurting U.S. soybean farmers in Illinois and Iowa and Minnesota and every one of our states that produces soy, who are already struggling under tariffs that are most charitably described as economically illiterate and are costing us billions of dollars in export revenue. U.S. farmers are now being forced to rely on emergency economic relief to deal with losses from the trade policies. This is a policy that the American Soybean Association described as putting a Band-Aid on an open wound. The Treasury Department and the Federal Reserve owe it to U.S. farmers and to the general public to explain how they are misusing taxpayer funds to bail out Argentina, especially at a time when nobody is falling for Trump's description of the high cost of living as an affordability hoax. I do want to say finally, Secretary Bessent has suggested that some of the information cannot be released because it's classified, and so this amendment includes a provision that says the Federal Reserve can include sensitive material in a classified annex of this report, which would be made available to members of this committee. I would urge all of my colleagues to support this amendment out of a commitment to greater accountability and transparency on the administration's politically motivated and economically illiterate actions. I yield back.
Gentleman yields back. Does the gentleman from Georgia insist on your point of order? He does not. The point of order is withdrawn. Who seeks recognition? Gentleman from Georgia.
Thank you, Mr. Chairman. I urge my colleagues to oppose the amendment from Mr. Caston. I believe it's irrelevant to the scope and the underlying purpose of my bill. The America First Act is about ensuring transparency and accountability in banking regulators, their interactions with international, global, and governance bodies. Congressional oversight should be targeted, not performative. Blanket disclosure requirements on interactions with foreign governments raise serious constitutional concerns about Congress trying to micromanage the executive branch's interactions with foreign governments. That is exactly why our bill appropriately balances these considerations. I urge my colleagues to oppose this amendment, and I yield back.
Gentleman yields back. Who seeks recognition on Mr. Caston's amendment? Mr. Green.
I move to strike the last word.
Gentleman's recognized for 5 minutes.
I support this amendment offered by our colleague, Congressman Caston from Illinois. If Republicans really want to put America first, then we should at least require the Federal Reserve, which acts as the Treasury Department's fiscal agent, to provide details about the transactions they have conducted to implement Trump's $40 billion bailout of Argentina. There needs to be more transparency of these transactions. Moreover, I renew an earlier request made by Ranking Member Waters to the chairman to work with Treasury to organize a briefing for all of our committee members so we may learn more specifics about the steps the Trump administration has taken to support Argentina at the risk of losing money for U.S. taxpayers. Our committee has oversight of any use of Treasury's Exchange Stabilization Fund, and similar to when it has been used to bail out Mexico and address other crises, we should exercise that oversight and shed some light on these mysterious transactions to help Trump's political ally and his friends on Wall Street. I urge members to support this amendment, and I yield back.
Gentleman yields back. Who seeks recognition? Not seeing others, I'll recognize myself for 5 minutes. I want to speak in opposition to Mr. Caston's amendment. I think it's not germane to the topic that we're talking about today, but I also want to say that it is true House Financial Services Committee and the Senate Banking Committee have oversight of the Exchange Stabilization Fund, and every year the Treasury reports the details of how they use the Exchange Stabilization Fund in a public annual report to the Congress. And twice a year, the Treasury Secretary spends time at this committee testifying, once on international economic matters, which would certainly include the Exchange Stabilization Fund, and once in his capacity overseeing the Financial Stability Oversight Council, the FSOC. So I think the committee has that ability to do that, and we've certainly, I share Ranking Member Waters' interest in a briefing on Argentina, and we've made that request to the department, but I believe that members should vote no on the Caston amendment, and with the idea that there is adequate disclosure and oversight responsibility already being exercised by the committee on this particular matter. I yield back the balance of my time. Who seeks recognition? Is there any other discussion? If there's no further debate, the question now occurs on Mr. Caston's amendment. All those in favor say aye. Aye. Any opposed say nay. Nay. Opinion of the chair, the nays have it. Nays have it. The amendment is not adopted.
Mr. Chair,
Gentleman?
request a recorded vote.
Gentleman has requested a recorded vote. All those in favor of recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings on the amendment are postponed. We'll now move to the next amendment on Mr. Loudermilk's bill. Is there another amendment? If there are no further amendments, without objection, the previous question on the substitute is ordered, and recorded votes on the pending amendment have been postponed. Once those votes are taken, the committee will immediately vote on the adoption of the amendment in the nature of a substitute, and then we'll consider the question to report the measure. We'll now move to the next bill. And in that regard, I call up, pursuant to notice, H.R. 6570, the Merger Agreement Approvals, Clarity, and Predictability Act, which was introduced by the gentleman from Wisconsin, Mr. Fitzgerald. The clerk will report the bill, which was distributed in advance.
H.R. 6570, to require the Comptroller General of the United States to study the use of commitments and conditions in connection with insured depository institution merger applications by federal depository institution regulatory agencies to ensure they align with statutory requirements and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. Representative Fitzgerald has an amendment in the nature of a substitute, copies of which were also distributed in advance. The clerk will report his amendment.
An amendment in the nature of a substitute to H.R. 6570, offered by Mr. Fitzgerald of Wisconsin, designated as Fitz GE 067.
Without objection, the amendment is considered read and will serve as base text for the purposes of amendment. The gentleman from Wisconsin, Mr. Fitzgerald, you're now recognized for 5 minutes to describe your amendment.
Thank you, Mr. Chairman. One of this committee's important responsibilities includes overseeing how banking regulatory agencies implement the laws we enact. Today's markup offers an opportunity to ensure clarity, consistency, and accountability in how merger approvals are handled. My legislation requires the Government Accountability Board, the GAO, to undertake a thorough review of how federal regulators use commitments and conditions when approving mergers of insured depository institutions. The study will examine quantifiable data, including how often commitments are imposed, under what circumstances, and whether those actions align strictly with statutory criteria. It also asks the GAO to determine whether regulators rely on extra statutory considerations, such as policy preferences or non-statutory goals when conditioning merger approvals. What this bill does is promote transparency and predictability. It ensures that institutions, large or small, know what is required for a merger based on law, not a shifting, informal agency expectation. For many community banks, mid-sized institutions, and credit unions, unpredictable conditions add costs, complexity, and risk. That uncertainty can chill beneficial transactions, inhibit consolidation where it makes sense, reduces efficiencies, and ultimately harm consumers and depositors. By asking GAO for an objective, data-driven study, we give this committee the information needed to determine whether regulators are operating within the boundaries Congress set. I urge my colleagues to support this bill. I hope it ensures the integrity of merger review process, strengthens regulatory accountability, and promotes fairness for all depository institutions, and I yield back.
Gentleman yields back. Who seeks recognition? Gentleman from Texas.
Thank you, Mr. Chairman. I move to strike the last word.
Gentleman's recognized for 5 minutes.
Thank you. The original version of this bill would have required GAO to review the extent that regulators use conditions as part of bank mergers. While that might be a matter the sponsor is focused on, there are many other elements of the merger that require process that warrant scrutiny. For example, merger applications have been rubber-stamped by our banking regulators for too long. Between 2006 and 2017, the Federal Reserve approved 3,316 merger applications. And while some applications were withdrawn, the agency formally rejected 0 applications during that time. Even when accounting for withdrawn applications, the approval rate has been extremely high. In 2021 and 2022, the Federal Reserve approved roughly 97% and 94% of M&A applications, respectively, even when factoring in withdrawn applications. So I want to thank the chairman and his staff and the bill's sponsor for working with us to expand the scope of these studies. The revised study will examine all other aspects of bank merger reviews and different approaches that regulators choose to use, including more stringent reviews and soliciting more public input through public hearings for the largest mergers. GAO will also examine how regulators could condition merger approval on the fulfillment of community benefits agreements to help ensure the merged bank satisfies the statutory requirement to meet the convenience and needs of affected communities. The updated bill will also analyze the impact that bank mergers have had on financial stability, competition, and availability of financial products and services offered by banks. With those changes, I support the bill. I yield back.
Gentleman yields back. Who seeks recognition? The gentleman from Kentucky, the chair of our Financial Institutions Subcommittee, Mr. Barr, you're recognized.
Thank you. I appreciate the gentleman's bill. Appreciate Representative Fitzgerald's legislation, the Merger Agreement Approvals Clarity and Predictability Act. I appreciate the bipartisan support from the gentleman from Texas, and obviously they've worked together to come up with a GAO study that will evaluate these conditions, and I think it's very, very important. I think this supplements the legislation that this committee has already approved, the Bank Failure Prevention Act, that would put some time limits and some shot clock parameters around review of bank merger applications. And one of the pieces of feedback that we get over and over again from banks seeking to either merge or acquire other institutions in a very healthy way is that a lot of these merger applications are held up based on these non-statutory conditions that are imposed on them. And in fact, some of these community benefits agreements are extracted from the institutions looking to merge when really there's no factual or legal basis for these conditions. So I think a study to look at whether or not these kinds of political factors are used to hold up otherwise healthy mergers that would facilitate a stronger, more resilient, more competitive banking system is a very good idea. I compliment the gentleman from Wisconsin for his leadership on this issue, which I think is very supplemental and complementary to the legislation this committee has already marked up, and I applaud the bipartisan support for the legislation as well. I urge my colleagues to support the legislation.
Would the gentleman yield?
I will yield, yes.
I thank the gentleman for his comments. I just want to add that I support Mr. Fitzgerald's bill. I think this will give us the data to provide any additional statutory or regulatory oversight of the M&A approval process. I appreciate the bipartisan cooperation on Mr. Fitzgerald's work, and I urge a yes vote, and I yield back to the gentleman from Kentucky.
Yield back, thank you.
Gentleman yields back. Is there further debate on the ANS? If there's no more debate, is there amendments? Anybody want to amend this ANS by Mr. Fitzgerald? Seeing no amendments, no further discussion, the question now occurs on the adoption of the amendment in the nature of a substitute. All those in favor of Mr. Fitzgerald's bill signify by saying aye. Aye. All those opposed signify by saying nay. Opinion of the chair, the ayes have it, and the amendment is adopted. The question now occurs on ordering the bill as amendment to be reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. In the opinion of the chair, the ayes have it.
Mr. Chairman,
Gentleman from Wisconsin.
can I ask for the yeses and nos on that bill?
A recorded vote is requested. All those in favor of recorded vote, raise your hands. Sufficient number having raised their hand, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, a vote on this question is postponed. We'll now, prior to moving to the next bill, we will, pursuant to the previous order, as votes have been called on the House floor, there are 2 votes. The chair declares the committee in recess, subject to the call of the chair. We will reconvene immediately after these 2 votes. The committee stands in recess. The committee will come to order following our recess. Pursuant to notice, I call up H.R. 6546, the Merger Process Review Act, which was introduced by the chair of our Small Business Committee, Mr. Williams of Texas. The clerk will report the bill, which was distributed in advance.
H.R. 6546, to require the Inspector General of each federal prudential regulator to carry out a review every 3 years of the regulator's handling of insured depository institution merger applications and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. Representative Williams has an amendment in the nature of a substitute, copies of which were distributed in advance. The clerk will report the amendment.
An amendment in the nature of a substitute to H.R. 6546, offered by Mr. Williams of Texas, designated as Will TX 051.
Without objection, the amendment is considered read and will serve as base text for the purposes of amendment. The gentleman from Texas, the chair of the House's Small Business Committee, Mr. Williams, you're now recognized for 5 minutes for your presentation.
Thank you, Mr. Chairman. And a strong and resilient banking system depends on clear rules, predictable oversight, and timely regulatory decisions. When bank merger applications face unnecessary delays, uncertainty increases, competition is reduced, and access to credit is constrained, particularly in rural and underserved communities. My bill, H.R. 6546, the Merger Process Review Act, is a straightforward oversight measure. It promotes transparency and accountability by requiring regular reviews by the Inspector General on how merger applications are processed. These reviews focus on measurable data, identity sources of delay, and provide recommendations to improve timeliness and efficiency, all while respecting each agency's statutory responsibilities. The bill also ensures Congress and the public have visibility into these findings and how regulators respond to them. At its core, this regulation reinforces good governance. Clear process and accountable regulators lead to a more stable financial system and better outcomes for consumers, small businesses, and local communities. So I want to thank the chairman for including this, my legislation in his markup. I urge my colleagues to support this common sense approach. I yield back the time that I have left.
I thank the chairman for his comments and for his bill. Who seeks recognition on Mr. Williams' A&S? Ranking, no, we're not ready to do an amendment yet. Anybody else want to speak on the underlying A&S? Yeah, I'm sorry. Ms. Waters, you're recognized to strike the last word. No amendment. You're going to speak on the bill.
Oh, I move to strike the last word.
Gentlewoman's recognized for 5 minutes.
This bill requires the Inspector General of the banking regulators to review how they handle certain aspects of the bank merger review process and to provide regular reports every 3 years. While we may have different concerns, I share the sponsor's desire to have greater scrutiny of the merger process. For far too long, merger applications have been rubber-stamped by our regulators, even as we've seen the rapid disappearance of thousands of community banks. So I want to thank the chairman and his staff and the bill sponsor for working with us to expand the scope of these studies. With these changes, the Inspector General will also consider all important aspects of bank merger reviews and different approaches that may be used, including more stringent reviews that regulators may attempt to take or efforts to solicit more public input through public hearings for the largest mergers. It is also important that IGs review the impact that these mergers have had on financial stability, competition, and availability of financial products and services offered by banks. With those changes incorporated into the bill, I support the bill. I yield back the balance of my time.
Gentlewoman yields back. Who seeks comment? I'll recognize myself for 5 minutes for comment. I just want to add my support for this good bill. Delays and uncertainty in the process disproportionately punish smaller and mid-sized institutions, which often seek mergers not to dominate markets, but simply survive, scale, and remain competitive against much, much larger banks. When the path to combining resources is slow and opaque, the unintended consequences that smaller banks are left with few viable options, inadvertently forcing consolidation upward. and hollowing out the middle of our distribution of commercial banks across the country. And I think this issue of this study will be very interesting to see the views on things like if you have two high-quality institutions, one-rated, two-rated banks, why that merger should be delayed and why it can't be just handled more expeditiously at the local Federal Reserve District Bank, and also speed of decision from the FDIC to approve the consolidation of the deposit insurance coverage. So I think this is a good bill. I appreciate Mr. Williams bringing it. Urge a yes vote and yield back the balance of my time. Does anyone else seek recognition on the A&S? Hearing none, we'll move to amendments. Does anyone have an amendment to Mr. Williams' bill? There being no further discussion or amendments to the bill, question now occurs on the adoption of the amendment in the nature of substitute offered by Mr. Williams. All those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. Opinion of the chair, the ayes have it. The amendment is adopted. Just a moment, sir. Question now occurs on ordering the bill as amended to be reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. In the opinion of the chair, the ayes have it. Gentleman from Texas.
Chairman, thank you. I call for a recorded vote.
Gentleman asked for a recorded vote. All those in favor of recorded vote, raise your hands. A sufficient number having raised their hand, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, the vote on this question is postponed. We'll now move to the next event, next measure. Tab was hidden. Pursuant to notice, I call up H.R. 6553, the TIER Act of 2025, which was introduced by the gentleman from Kentucky, Mr. Barr, the chair of our Financial Institution Subcommittee. Clerk will report the bill, which was distributed in advance.
H.R. 6553, to index statutory thresholds and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. Representative Barr has an amendment in the nature of a substitute, copies of which were also distributed in advance. The clerk will report the amendment.
An amendment in the nature of a substitute to H.R. 6553, offered by Mr. Barr of Kentucky, designated as Bar 124.
Without objection, the amendment is considered read and will serve as base text for the purposes of amendment. Gentleman from Kentucky, Mr. Barr, you're recognized for 5 minutes.
Thank you, Mr. Chairman. I move to strike the last word. Thank you.
Gentleman's recognized on his amendment.
Today, we are considering my legislation, H.R. 6553, the Tailoring and Indexing Enhanced Regulations Act, or the TIER Act. This legislation indexed thresholds for Category 2, 3, and 4 banks to nominal GDP to change the static nature of the thresholds that stifles economic growth. As the economy grows, banks also need to grow to meet the demands of our capital markets, their clients, and funding needs of other financial services companies. However, the current static thresholds impede this growth and limit banks' capacity in our economy. Regulatory tailoring is an important tool. We recognize this in S2155 in a bipartisan bicameral basis. We actually embedded it in statutory law. And it's important because we need to maintain the diversity and strength of our economy, and it's paramount that our financial laws properly account for this. As the economy grows and as inflation rises, the volume of banks' real inflation-adjusted assets grows with the economy, and the nominal value of banks' assets rises with inflation. This means banks' respective asset sizes can increase in nominal terms on paper despite still being the same size relative to the wider economy in real inflation-adjusted terms. This is particularly pronounced in times of high inflation, meaning this phenomenon has especially impacted banks over the last few years as we have witnessed historically high inflationary pressures. To ensure our large banks can support the economy, we must index these thresholds and pass the TIER Act. It's important as we consider indexing, as important as we consider tailoring, that we remember that regulation, one-size-fits-all regulation is not appropriate. What is appropriate is that the regulations fit the size, complexity, and risk profile of each institution. And what we don't want in this country is a barbell banking system where you have a few handful small community banks and too big to fail GSIB banks. We need that diversity along the spectrum of bank sizes, and we need each segment of the banking sector to serve each segment of the economy as those different banks serve different aspects of the economy. So regulatory tailoring accommodates that, it accomplishes that. And I do anticipate from some of the critics of this legislation, maybe from our friends on the other side of the aisle, that this is risky. This is a risky idea because we saw what happened with Silicon Valley Bank. On the contrary, this is the precise antidote to what we saw with Silicon Valley Bank. Silicon Valley Bank was largely a product of interest rate mismanagement and supervisory failures. It was not the product of regulatory tailoring. What we don't want to see happen is the regional mid-sized banks so pressured by regulations that they simply cannot exist anymore. And all we have is large, too big to fail banks and small community banks. Regulatory tailoring accommodates that diversity. It provides the common sense relief for those mid-size and regional banks so that they can continue to grow and so that they can continue to serve their customers based on their risk profile. So with that, Mr. Chairman, I urge my colleagues to support this measure, and I yield back.
Gentleman yields back. Who seeks recognition? The ranking member of the full committee, Ms. Waters, you're recognized.
Thank you very much. I move to strike the last word.
Gentlewoman's recognized for 5 minutes.
Just 2 years, 2 short years, after 3 of the 4 largest banks in the United States history failed, Republicans are back with more efforts to deregulate these regional banks. Let me briefly recap the journey we've been on with regional bank regulation. Following the 2008 financial crisis, Congress passed Dodd-Frank and required the Fed to impose stronger standards for banks with more than $50 billion in assets. These standards covered capital, liquidity, stress tests, and living wills, which all promote the safety and soundness in the banking community. During Trump's first term, Congress made the misguided step to increase this threshold to a bifurcated one where banks under $100 billion in total assets would be exempt. Banks between $100 billion and $250 billion could have heightened standards, and only those above $250 billion in assets faced a mandatory application of the enhanced standards. Can you guess how large the regional banks were when that failed and required the U.S. government to use emergency tools to stabilize? That's right. Signature Bank had $110 billion in assets, and Silicon Valley Bank had $212 billion in assets. They were in that bucket that didn't have to have robust capital and other standards. So, Mr. Chairman, memories fade past. Today, we're considering a bill to again increase the threshold so that the only banks that are required to have enhanced standards are those with more than $370 billion. And then these households will grow rapidly because the bill indexes them to nominal GDP growth. Now, Republicans will talk about the need to index our asset thresholds so that they are not static. I'm open to that discussion, but note that I never hear Republicans offer proposals to index programs that benefit consumers, like an index to the level of deposit insurance consumers or small businesses receive. But the regional bank crisis 2 years ago gives me no comfort that the thresholds set during Trump's first term was the right approach, nor that 2 years later we should need another substantial increase to the threshold. Is that clear to everybody? So I urge members to oppose this bill that further jeopardizes the safety and soundness of our banking system. I yield back.
Gentlewoman yields back. Who seeks recognition? From Pennsylvania?
Thank you, Mr. Chairman. I move to strike the last word.
Gentleman's recognized for 5 minutes.
I support H.R. 6553, the TIER Act, introduced by Representative Andy Barr, which I also co-sponsor. Today, federal banking regulation relies on asset-based thresholds that automatically trigger enhanced prudential standards, stress testing, and other large bank requirements once a bank crosses certain dollar amounts. Most of those thresholds were set in 2010 and have remained essentially frozen, despite more than 40% inflation and significant economic growth since then. The practical effect is that banks well under $50 billion that are considering a merger must begin planning years in advance to comply with large bank regulations simply because crossing the $100 billion Category 4 threshold, triggering a different regulatory regime, regardless of actual risk. The TIER Act fixes this problem by adjusting multiple regulatory thresholds, including the Category 4 threshold, to reflect economic growth and then indexing those thresholds to nominal GDP on an ongoing basis rather than letting inflation determine bank regulation. This ensures regulation remains risk-based, predictable, proportional, instead of forcing healthy banks into higher regulatory categories simply because prices and balance sheets have grown over time. This is thoughtful tailoring, making sure the framework works as Congress intended. So I urge my colleagues to support H.R. 6553, and I yield back.
Gentleman yields back. Who seeks recognition? Gentleman from Texas, you're recognized.
Thank you, Mr. Chairman. Banking regulation works best when it's tailored to actual risk and grounded in economic reality. Asset-based thresholds were intended to prevent one-size-fits-all rules from being imposed on institutions that do not pose the same level of risk. H.R. 6553, the TIER Act, addresses a basic structural problem in the current framework, and many regulatory thresholds are static dollar amounts that do not adjust for economic growth or inflation. Over time, this leads to regulatory creep, pulling banks into more complex regimes even when their risk profile has not meaningfully changed. This bill updates these thresholds for Category 2, 3, and 4 banks and indexes them to nominal GDP going forward. Doing so preserves the original intent of tailoring by ensuring that regulatory requirements remain aligned with size, complexity, and risk. The TIER Act does not roll back safety and soundness standards. It promotes predictability, supports effective supervision, and helps ensure that financial institutions can continue to provide credit to households, small businesses, and local economies. I want to thank Representative Barr for his leadership on this important issue and urge all my colleagues to support this thoughtful and measured approach. Thank you, Mr. Chairman. I yield back the balance of my time.
Gentleman yields back. Seeks recognition. Hearing none, we'll move to amendments. Does anyone wish to offer an amendment to Mr. Barr's A&S? There being no further discussion or amendments to the bill, the question now occurs on adoption of the amendment in the nature of a substitute. All those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay.
Nay.
In the opinion of the chair, the ayes have it. The amendment is adopted. Question now occurs on ordering the bill as amended to be reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay.
Nay.
In the opinion of the chair, the ayes have it.
Mr. Chairman,
Gentleman from Georgia.
move for a recorded vote.
Gentleman from Georgia asks for a recorded vote. Those in favor of recorded vote, raise your hands. Sufficient number having raised their hand, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 Committee Rules, the vote on the question is postponed. We'll now move to the next bill. Pursuant to notice, I'll call up H.R. 1181, Protecting Privacy in Purchases Act, which was introduced by Representative Moore of West Virginia. The clerk will report the bill, which was distributed in advance.
H.R. 1181, to prohibit payment card networks and covered entities from requiring the use of or assigning merchant category codes that distinguish a firearms retailer from general merchandise retailer or sporting goods retailer and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. Representative Loudermilk has an amendment in the nature of a substitute on behalf of Mr. Moore, copies of which have been distributed in advance. The clerk will report that amendment.
An amendment in the nature of a substitute to H.R. 1181, offered by Mr. Loudermilk of Georgia on behalf of Mr. Moore of West Virginia.
Without objection, the amendment is considered read, will serve as base text for the purposes of amendment. The gentleman from Georgia, Mr. Loudermilk, is now recognized for 5 minutes to describe Mr. Moore's amendment.
Thank you, Mr. Chairman. Today, I urge my colleagues to support H.R. 1811, the Protecting Privacy and Purchases Act. In 2023, California and Colorado each enacted laws requiring banks and credit card companies to assign merchant category codes to firearms dealers within the state. In practice, these laws compel financial institutions to track lawful, constitutionally protected consumer purchases. Congress has repeatedly rejected the creation of a national gun registry, and Americans' Second Amendment rights are clear and well established. This bill defends those rights by preventing the creation of a financial tracking system for lawful firearms purchases and ensuring that a backdoor gun registry is not built through the misuse of financial data. The financial infrastructure of this country must remain neutral. It should not be weaponized to advance political and social agendas, and financial institutions should not be placed into the role of policing lawful behavior. H.R. 1811 ensures that Americans can exercise their constitutional rights without being subjected to enhanced financial surveillance, and I yield back.
Gentleman yields back, who seeks recognition on Mr. Moore's bill. Gentleman from California.
Thank you, Mr. Chair. An amendment is at the desk.
Gentleman moves to strike the last word,
I do, and move to strike the last word.
and you're recognized for 5 minutes.
Thank you, Mr. Chair. The amendment is at the desk.
Oh, no, we're not doing amendments, Mr.
Oh, forgive me.
Mr. Lucco. Yeah, we're debating the amendment in the nature of substitute right now.
If I could then just be heard briefly on that issue, I want to.
No, well, are you going to speak on the bill then and not an amendment?
I would like to speak on the amendment. Is that time going to be removed from my?
Do that after.
All right, I'll wait. Thank you. I'll yield.
Okay, gentleman yields. Ranking member of the full committee, you're recognized.
I move to strike the last word.
Gentlewoman's recognized for 5 minutes.
I strongly oppose this and any other bill that could limit efforts to combat gun violence. Let's start with a few sobering stats. Americans are 26 times more likely to be shot and killed than if you lived in any other high-income country. On average, 327 people are shot in the United States daily. This includes 23 minors who are shot daily. On average, 117 people die every day in the United States because of gun violence. Over the weekend, we had yet another school shooting when 2 students were shot and killed at Brown University. 9 others were shot and injured. Now, a few states, including my home state of California, have taken action to require payment card networks to use a merchant catalog code, or MCC, to distinguish firearm retails from other types of retailers. This information could be used to help law enforcement track suspicious purchases and prevent even more gun violence. Leading gun safety groups, including Brady, Community Justice, Everytown for Gun Safety, Guilford's Guns Down America, and Newtown Action Alliance, sent a letter to urge members to vote no on this harmful legislation. Mr. Chairman, I ask unanimous consent to enter their letter into the rolls.
Without objection, to be added to the record.
Thank you. In their letter, the groups noted that between 2007 and 2018, credit cards were used to finance at least 8 major mass shootings. One of these included the shooting at Pulse nightclub in Orlando, Florida, where 49 people were killed and 50 more were injured in June 2016. Just days before the shooter opened fire, his internet search history included the terms credit card, unusual spending, FBI, and why banks stop your purchases. He had opened 6 new credit card accounts in the 8 months prior to and 7 days before the shooting, spent $26,532 on, among other things, a rifle, a semi-automatic pistol, several large magazines, and thousands of rounds of ammunition. Before this, his average monthly spending on the single card was $1,500. None of the credit card operators, payment processors, or banks were alerted to the types of transactions being undertaken, and they did not notify law enforcement officials about these purchases. Americans are tired of the senseless gun violence and want Congress to enact stricter gun control measures. Unfortunately, this bill simply goes in the opposite direction and would implement a ban on such reporting on the federal level and would preempt states like mine that want to do whatever they can to protect their residents. I strongly urge members to vote no on this bill and yield back.
Gentlewoman yields back. Gentleman from Tennessee, Mr. Rose, you're recognized.
Mr.
Right to
Chairman, I
last-
move to strike the last word.
You're recognized for 5 minutes.
The Protecting Privacy in Purchases Act addresses a disturbing trend where payment card networks and financial institutions have sought to create special merchant category codes to track and categorize purchases of firearms, purchases at firearms retailers. Let me be clear about what's at stake here. This isn't about fraud prevention or transaction security. Payment card networks already have robust systems to detect and prevent fraudulent activity. This is about creating a registry of lawful firearm purchasers through the back door, something that Congress has repeatedly rejected and the American people strongly oppose. The Second Amendment guarantees the right to keep and bear arms. It does not come with a caveat that says private financial companies can surveil, track, and create databases of Americans exercising that constitutional right. When a constituent in Tennessee's 6th District walks into a sporting goods store to purchase a hunting rifle, ammunition, or accessories, their credit card company should not be flagging that transaction with a special code that effectively creates a watch list of Second Amendment exercisers. That's not the role of Visa, MasterCard, or any payment processor. This is about fundamental privacy. It's about preventing the kind of financial surveillance that could chill the exercise of constitutional rights. And it's about ensuring that unelected corporate boardrooms don't get to decide which lawful purchases deserve special scrutiny and which don't. The bill protects the privacy and constitutional rights of millions of law-abiding Americans who choose to exercise their Second Amendment rights. It ensures that private financial companies cannot create the surveillance infrastructure that our government is prohibited from establishing. I'm proud to be an original co-sponsor of this bill, and I thank my colleague, Representative Riley Moore, for spearheading this effort. I urge my colleagues to support this common-sense privacy protection measure, and I yield back the balance of my time.
Gentleman yields back. Who seeks recognition? The gentleman from Illinois.
Strike the last word.
Gentleman's recognized for 5 minutes.
Look, I don't often say this, but this bill is not bad. This bill is offensive, especially after the events of this weekend. We get opportunities in this committee all the time to vote on things that are going to affect people's wealth. We don't often get the opportunity to vote on bills that are going to decide whether or not Americans die, but this is one of those bills. We just had 2 mass shootings this weekend. This bill would block credit card companies from using just a specific merchant category code for gun retailers. This is a tool that's used in nearly every type of business. If you buy a razor, if you buy a wig, if you buy an alarm clock, there's a merchant category code. Who the hell is out there saying that's an infringement on privacy? How are you to know that I need a wig? That would be insanely stupid, and we don't do it. In 2022, there was an MCC for gun stores approved by the International Organization for Standardization. New York Times investigation found that between 2007 and 2018, 8 of 13 mass shootings were financed with credit card purchases. Many of them were made just weeks before shootings. How many people would be alive today if we had the tools to monitor that? How many will die if we don't? As Ranking Member Waters said, the 2018 shooting in Aurora, Colorado, the shooter spent $11,000 on weapons using a MasterCard just days before. The 2016 Pulse nightclub shooting, the shooter had not only opened 6 new credit card accounts, purchased $19,000 worth of weaponry ahead of the attack, but his Google search history included "why banks stop your purchases." When the next shooter Googles that, they're going to find this hearing. And they're going to say, sweet, Congress made it possible for me to buy a gun that no one can track, thanks to the good work of the Republican Congress. Now, several states, including California, New York, and Colorado, have led by enacting state laws to mandate that banks and credit card companies don't do this or can track this. Several other states, like West Virginia, Texas, and Florida, have enacted laws to prohibit the use of this code. Is it more important for Americans to get shot than to protect states' rights? Do we want government to intervene in the private sector and protect businesses who think that they have a moral obligation to look out for the least of these? Free market capitalism, small government? I thought those things were things that my colleagues across the aisle cared about. And I just want to stress, please don't offend us by saying this is about the Second Amendment. Come on. The Second Amendment does not mention merchant category codes. The Second Amendment does not say the right to protect people from getting murdered unless they are murdered with a knife, a bat, poison, an oven, a CO off the back of your exhaust, or anything else that is not a gun shall not be infringed. This is about whether we as Americans are going to allow people to track things. And I just want to close with a quick story about how toxic this culture of let's stick our head in the sand and allow people to shoot because we think it's cool to have a toy that goes bang. I would encourage all of you, take a visit out to Morgantown, West Virginia. Go to the ATF offices. They receive millions of boxes of reports from gun stores that have gone bankrupt, and they send the reports in so that they can be stored so that we can do background checks. We have government employees who are feeding those machines, millions of them, into photocopiers to make them into PDFs, and then are required by laws that this Congress has passed to take all identifying information out of those forms so that you can't search them by personal people. You can't search up personal names. So everybody who's out there saying guns don't kill people, people kill people. We have passed laws so you can't actually track the bad people. And so now this committee is going to say, you know what, I want to make it harder still to not be able to track the bad people because I want to protect someone who's going to go and shoot some kid at a school. I would ask you all to show half the courage of a 6-year-old sitting in a classroom at Uvalde, staring down the barrel of a gun. Do you have the courage to stand up to the NRA? Or are you going to let more kids get shot? I don't usually get this hyped, but this one is disgusting, offensive, and you should be ashamed of yourself, and I urge a hell no on this one. I yield back.
Gentleman yields back, seeks recognition. Hearing none, we'll go to amendments. Mr. Liccardo.
Thank you for your patience, Mr. Chair. I move to strike. Last word.
You have an amendment?
Yes, I move to strike.
Amendment's at the desk. We'll let it be distributed.
So number 078.
Mr. Loudermilk. Gentleman from Georgia reserves a point of order on the Liccardo amendment. Chief Economist.
Thank you.
Clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 1181, offered by Mr. Liccardo of California, designated as Licar 078.
Without objection, the amendment is considered read. The gentleman from California is now recognized to discuss his amendment.
Thank you, Mr. Chair. The amendment's been presented would strike the preemption provision and replace that text to give deference to those states that may want to, in fact, utilize having a separate MCC. These designations are critically important. I think it's important now to clarify some inaccuracies, what's been said already. First of all, the designation of a separate merchant code for gun stores did not begin in Colorado or California. It started back in September 2022, and the International Organization for Standardization, which issues these standards, created a merchant category code for firearm retailers. This is the 4-digit code. It's assigned to describe a merchant's primary purpose. It is not a backdoor gun registry. It cannot track any individual purchases. It only tracks aggregate retail store sales. It cannot erroneously flag trips to large retailers like Walmart's or Dick's Sporting Goods, because those large retailers sell a diverse set of goods that receive a different MCC. It is narrowly defined to apply to individual gun shops. Now, it's important to understand what this is for. Yes, it is important for card issuers for a range of purposes, including reporting and risk management, and they should be able to manage these risks and have the data to do so. And as someone who used to prosecute crime, and as a former mayor, I appreciate the value of tracking surges in gun purchases because we know it is important to identify those gun store outlets that might be violating very standard local rules, like background checks, actually federal rules as well, anti-fencing rules, straw purchasing rules, all of which are designed to prevent guns from getting into the wrong hands, in the hands of people who cannot legally own them or possess them. That is critical. And we know that often we see surges in particular stores where criminals understand they can get away with it. So it is important to track this data. Again, not to the individual, not to the gun owner, but to the gun store, the vendor. Now, in September 2023, California did pass a law that would require the use of a firearms merchant code by May 2025. And on the other side of the spectrum, Florida and Texas enacted bills prohibiting the use of firearms MCCs. So it is in this laboratory democracy, the many 50 laboratories we have throughout our country. We'll see different rules and we'll understand what the consequences of those rules are. And that may help us better understand what combination of policies will actually save lives. But Texas suffers 15 firearm deaths for every 100,000 residents. That's according to the U.S. Center of Disease Control. Florida has about 14 deaths per 100,000 population. California has 8. I think we ought to let the states understand how best to protect their own residents, because clearly in Congress we have failed to be able to do so ourselves. I yield.
Gentleman yields back. Does the gentleman from Georgia insist on your point of order? Gentleman withdraws his point of order. Is there further debate on Mr. Liccardo's amendment? Gentleman from Georgia.
Move to strike last word.
Gentleman's recognized for 5 minutes.
Thank you, Mr. Chairman. I urge my colleagues to vote against the amendment. And let me clarify something that my good friend from the other side of the aisle that's still in the chamber here brought up. And he was exactly right, which is the fallacy of the argument that the other gentleman from the other side of the aisle was making earlier in his passion plea. This would do nothing to identify if somebody bought a firearm. I'll give you a prime example. If I go to a major retailer that is prominently known for selling camping gear and fishing gear, and that is what their code identifies as, and I buy a gun, it does not identify that I bought a firearm. But if I go to a firearms store and I buy a backpack, then it's going to show up that I bought a firearm. There is nothing logical about this. Tracking firearm retailers through separate merchant category codes is not about trying to prevent criminals from accessing guns. It's about trying to intimidate law-abiding citizens and gun retailers from exercising their constitutional Second Amendment, and this is about the Second Amendment. States are not empowered to infringe on Second Amendment rights. I heard the words from my colleague across, and yes, I'm emotional about this, that we didn't have the courage. We didn't have the courage to stand. Until you have faced a shooter face to face and looked down the barrel of a firearm that is actively shooting you, as I have, don't come to me and talk about courage. The reason that shooter got off as many rounds as he did is because none of us had a way of protecting ourselves. I urge my colleagues to vote against this amendment, and I yield back.
Would the gentleman yield?
I do.
I thank the gentleman for his passion. I want to urge a rejection of the amendment as well. And I say it because I've listened to the debate very carefully, and I agree with the gentleman from Georgia that this is not in any way documenting anything other than an attempt, I think, to intimidate dealers from selling firearms, because don't forget, if you're subject to a background check, you've delivered your social security number, your address, your cell phone number, your immigration status, everything about yourself to that firearms dealer to approve whether or not you can buy that firearm. And that's federal documentation at that retail store. It's far more, specific to the purchase of that firearm rather than the credit card is documenting a sporting goods sale versus a specific firearm. So I agree with the gentleman from Georgia. I would urge and I also agree with the state's rights issue on a constitutionally protected right. So I would urge a rejection of the Liccardo amendment, and I yield back the balance of my time, and I recognize the gentleman from California for her to strike the last word.
Thank you. I join with the chairman on states' rights that he supports. I move to strike the last word.
Gentleman's recognized for 5 minutes.
Thank you. I support this amendment. Republicans often tout the importance of letting states be the laboratories of democracy. So even if they disagree with us on this policy, I would hope they would hold true to their support for states' rights in this instance and not preempt states that are seeking to take action to protect the residents. And California, my state, is one of those. So I urge members to support this amendment, and I yield back.
Gentlewoman yields back. Is there further debate on the Liccardo amendment? If there's no further debate, the question now occurs on the Liccardo amendment. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed signify by saying nay. Nay. In the opinion of the chair, the nays have it. The nays have it. The amendment is not adopted. We'll now move to our next amendment.
Seek recorded vote.
The gentleman from California.
I'd seek a recorded vote.
The gentleman has requested a recorded vote. All those in favor of recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is so ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, further proceedings of the amendment are postponed. Is there further amendment to the Riley Moore bill? Or to, I beg your pardon, to the Loudermilk A&S on the Moore bill? Seeing no further amendments, without objection, the previous question on the substitute is ordered, and recorded votes on the pending amendment have been postponed. Once those votes are taken, the committee will immediately vote on the adoption amendment in the nature of a substitute, and then we'll consider the question to report the measure. We now move to the next bill for consideration. Pursuant to notice, I call up H.R. 6551, the New Bank Act of 2025, which was introduced by Representative Loudermilk of Georgia. Clerk will report the bill, which was distributed in advance.
H.R. 6551, to require annual reports on National Bank and Federal Savings Association charter applications, depository institution holding company applications, Federal Deposit Insurance applications, and State Depository Institution charter applications, and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. Representative Loudermilk has an amendment in the nature of a substitute, copies of which have been distributed in advance, and ask the clerk to report that amendment.
An amendment in the nature of a substitute to H.R. 6551, offered by Mr. Loudermilk of Georgia, designated as Louder 027.
Without objection, the amendment is considered read and will serve as the base text for purposes of amendment. The gentleman from Georgia, Mr. Loudermilk, you're now recognized for 5 minutes.
Well, thank you, Mr. Chairman. I speak today in support of my bill, H.R. 6551, the New Bank Act. My bill would require the Federal Reserve Board, Office of the Comptroller of the Currency, FDIC, and the National Credit Union Administration to publish annual reports on applications received from Federal Depository Institution charters, Depository Institution holding companies, Federal Deposit Insurance, and State Depository Institution charters. These reports will help give critical insights to the current de novo chartering process and how Congress can reduce complexities and redundancies in the system. As financial institutions across the country, and many of us here know, the de novo chartering process is a multi-layered and complex. Timelines for these applications are often unpredictable, evaluation criteria are unclear, and the initial costs for filing and startup capital are sometimes prohibitive. It is important to evaluate if there are ways to simplify and streamline the chartering process so that financial institutions that want to serve their communities can meet their procedural and compliance requirements with federal and state banking authorities without going belly up before they even open their doors. I believe that the new Bank Act represents a thoughtful approach to gaining more transparency by first gathering essential data on bank charter applications and reviewing the mean and median approval times and common reasons for denials before determining the appropriate response from Congress. I urge my colleagues to support this bill, and I yield back.
Gentleman yields back. Who seeks recognition of Mr. Loudermilk's bill? Gentlewoman from California, ranking members.
I move to strike the last word.
You're recognized for 5 minutes.
We've had far too few new banks form in recent years, and I appreciate the work of our committee to try and tackle this challenge. Earlier this year, I was pleased when the chairman marked up my bill, H.R. 4544, the American Access to Banking Act, and I thank all of you for supporting that measure. My bill would make a series of reforms to the de novo application process to promote the formation of new community banks and credit unions. These reforms would reduce unnecessary burdens on applicants, inform applicants how to navigate the process, improve communication, and strengthen coordination between regulators to further support the creation of community banks and credit unions, including MDIs and CDFIs, and rural institutions. I also know that our colleague, Representative Barr, cares a lot about this issue too, and I have not given up hope that we might be able to work out a compromise on this de novo bank bill. Mr. Loudermilk's bill allows us to gather more data about new bank applications, including data on cryptocurrency firm applications for national trust charters. With that data, we can identify other steps we can take to support the formation of more new banks. While I'm supportive of this bill, I plan to offer an amendment to ensure we get more granular data to support the creation of even more community financial institutions. I thank you, and I yield back.
Gentlewoman yields back. Seeks recognition on Mr. Loudermilk's A&S. I'll recognize myself for 5 minutes in support of the bill. I support H.R. 6551, New Bank Application Numbers Knowledge Act, offered by Mr. Loudermilk. The process of chartering a new bank in America has become a multi-layered, costly, and frequently unpredictable burden. It reinforces experienced players, particularly incumbents. With prospective bank founders facing a prolonged and complex process, approval by the Fed, approval from a principal regulator, approval from the FDIC, and having to raise, the FDIC estimates between $15 and $30 million in startup funding in order to capitalize a new bank, you can see why it's a challenge for new bank charters to take place. So that's why this bill, I think, makes sense to measure and require regulators to publish the essential data on applications, including the median approval times, the common reasons for denial, withdrawal, or expiration. And it just shines light on what many have called the black box of de novo application process. So I really appreciate Mr. Loudermilk offering this to offer hope to all those aspiring bank managers that would like to start their own institution in a growing market in the U.S. I urge members to support the bill, and I yield back the balance of my time. Does anyone else seek recognition on the A&S? Hearing none, we'll move to amendments. Does anyone wish to offer an amendment to the A&S? The ranking member has an amendment at the desk. We'll pause for that to be distributed.
Okay, all right. Okay, they're gonna bring it up? All right.
Gentleman from Georgia reserves a point of order. Clerk will report the amendment.
An amendment to the amendment in the nature of a substitute to H.R. 6551, offered by Ms. Waters of California, designated as H.R. 655101.
Without objection, the amendment will be considered read, and the gentlewoman from California, Ms. Waters, is now recognized to go over her amendment.
Thank you very much, Mr. Chairman. As we ask regulators to report on data about the creation of new banks, my amendment would ensure that as this data is collected, we get a specific breakdown of how new bank applications are playing out for community development financial institutions, that's CDFIs, minority depository institutions, MDIs, women-owned banks, as well as rural banks. Earlier, I discussed my bill, H.R. 4544, the American Access to Banking Act, which would make some process improvements to support the creation of a new bank. My bill was informed by feedback this committee heard at a hearing earlier this year from Rashonda Young, the entrepreneur in Iowa, who is seeking to start a new MDI and CDFI bank in Iowa to provide the kind of access to a small business credit to her neighbors in rural America that she herself was denied. Furthermore, several weeks ago, the chairman convened a hearing on deposit insurance reform where we discussed my bill and other proposals, and I was pleased that the chairman invited Jill Castella, chairman, president, and CEO of a woman-owned bank operating in Oklahoma. So my amendment will ensure that whenever groups like those, led by Ms. Young and Ms. Castilla, to try to start a bank, we get more data about their experiences to ensure we identify and knock down every barrier to the formation of new banks. So I urge members to support this amendment, and I yield back.
Thank the gentlewoman. Does the gentleman from Georgia insist on his point of order?
I withdraw, Mr. Chairman.
Gentleman withdraws it. Is there further debate? Gentleman from Georgia.
Move strike the last word.
Gentleman's recognized.
Thank you, Mr. Chairman. I urge my colleagues to oppose this amendment for the same reason I raised regarding the previous proposed amendment to Mr. Norman's Rural Depositories Revitalization Act. The purpose of this bill, right-sizing regulation to reduce or eliminate unnecessary regulation during the chartering process, is precisely the relief that CDFIs need to continue their important work. To that end, this amendment is unnecessary. Under existing federal law, CDFIs are already covered by the provisions of this bill. Singling out CDFIs risks creating redundancy, confusion, or unintended carve-outs that could undermine the clarity and consistency of the framework that we are establishing. This bill seeks to understand the chartering process and provide greater transparency to the banking sector. This helps CDFIs, and they are covered under this bill. For those reasons, I oppose this amendment, and I urge my colleagues to do the same. I yield back.
The gentleman yields back. Is there further debate on Ms. Waters' amendment to the Loudermilk measure? If there's no further debate, the question now occurs on the Waters amendment. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed signify by saying nay. Nay. Opinion of the chair, the nays have it. Nays have it, and the amendment is not adopted. We'll now move to the next amendment. Is there any other amendment on the Loudermilk measure? If there is no further discussion or amendments to the Loudermilk A&S, the question now occurs on the adoption of the amendment in nature of a substitute. All those in favor signify by saying aye. Aye. All those opposed signify by saying nay. Opinion share the ayes have it, the amendment is adopted. Question now occurs on ordering the bill as amended to be reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. Opinion share the ayes have it. Gentleman from Georgia.
That's for a recorded vote.
Gentleman from Georgia requests a recorded vote. All those in favor of recorded vote, raise your hands. A sufficient number having raised their hand, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, a vote on this question is postponed. We'll now move to the next bill. Pursuant to notice, I call up H.R. 6544, the Review Act of 2025, which was introduced by the gentleman from South Carolina, Representative Timmons. Clerk will report the bill, which was distributed in advance.
H.R. 6544 to require the federal financial institutions, regulatory agencies to review the cumulative impact of regulations issued by such agencies and for other purposes.
Without objection, the bill is considered read and open to amendment at any point. Representative Timmons has an amendment in the nature of a substitute, copies of which were distributed in advance. The clerk will report that amendment.
An amendment in the nature of a substitute to H.R. 6544 offered by Mr. Timmons of South Carolina, designated as Tim SCS 029.
Without objection, the amendment is considered read and will serve as the base text for purposes of amendment. The gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes for a presentation on his amendment.
Thank you, Mr. Chairman. Today, this committee will mark up my bill, the Regulatory Efficiency, Verification, Itemization, and Enhanced Workflow Act of 2025, known as the Review Act. I'm pleased to present this legislation because it strengthens the ability of our financial regulators to maintain rules that are effective, appropriately tailored, and responsive to the needs of both consumers and institutions. When Congress first created the requirement for regulators to review their existing rules, the financial system operated in a very different environment. The pace of innovation was slower, financial products were less diverse, and supervisory expectations were more uniform. A review every 10 years may have been sufficient at that time, but is no longer adequate for a modern financial system. The Review Act updates this outdated structure by requiring agencies to conduct these reviews every 5 years. More importantly, the Review Act places a strong emphasis on regulatory tailoring. A one-size-fits-all approach to regulation can create unnecessary burdens for smaller institutions, limit access to credit in underserved communities, and stifle responsible innovation. By expanding the review requirement to all federal financial institutions, regulatory agencies, and by directing each agency to conduct a cumulative impact assessment of its rules, the bill ensures that regulators closely examine how their requirements operate in practice for different types of institutions. The internal review process established in this bill requires agencies to assess how their regulations affect consumers, community lenders, credit availability, market liquidity, and economic activity. It also requires agencies to identify rules that are duplicative, outdated, or overly complex. This type of analysis is essential to effective regulatory tailoring. It ensures that regulation remains strong where it is needed, but is calibrated appropriately for the wide variety of institutions that serve our financial system. The goal of the Review Act is not to weaken regulation. The goal is to strengthen it by ensuring that regulators have a clear, structured method for updating rules so they remain modern, efficient, and targeted. Tailored regulation promotes both safety and soundness and economic opportunity. It ensures that oversight is rigorous without being unnecessarily burdensome, and it allows consumers and businesses to benefit from a financial system that evolves responsibly. I believe this bill represents a practical and meaningful improvement to the regulatory framework. It encourages thoughtful review, promotes regulatory clarity, and supports a financial system that is both safe and dynamic. Mr. Chairman, I urge my colleagues to support the Review Act and to support the continued effort to maintain a regulatory structure that is both strong and appropriately tailored. Thank you, and I yield back.
Gentleman yields back. Who seeks recognition on Mr. Timmons' bill? Ranking member? Strike the last word on Mr. Timmons' bill.
Which bill is that? This one. 6544?
Gentlewoman is recognized to strike
I
the
move
last
to
word.
strike the last word.
You're recognized for 5 minutes.
I strongly oppose this bill, which appears designed to further Trump's reckless banking agenda and tie up our regulators with frequent and exhaustive regulatory reviews. Instead of focusing their attention on where it should be, supervising and regulating banks. Already, banking regulators are required to do an exhaustive review of all of the regulations every 10 years in order to identify outdated or otherwise unnecessary regulatory requirements imposed on insured depository institutions. This is an extensive process, and the last time the regulators did this, it took them 3 years to conduct extensive outreach, analysis, and produce a report with extensive recommendations. Trump's regulators are already reducing their supervisory staff, with the Fed cutting their workforce by 30%. To make regulators do this, regulatory review every 5 years would severely limit their ability to do their day jobs. 2 years after the failure of Silicon Valley Bank and others, this committee should be strengthening the safety and soundness of our banking system, not tearing down safeguards. I urge members to vote no on H.R. 6544.
The gentlewoman yields back. Who seeks recognition on Mr. Timmons' A&S? I'll recognize myself for 5 minutes. I join Mr. Timmons in supporting his bill, the Regulatory Efficiency Verification, Itemization, and Enhanced Workflow or Review Act. I appreciate him bringing it to the House floor, to the House committee. Well, I understand that this is burdensome on the regulators to do this kind of analysis, and that, in fact, they've been asked by Congress to at least do it every decade. When I was in commercial banking and in also investment banking, regulated both in the brokerage space and the banking space, you just saw time and time again rules that were layered on top of layers. And when Congress asks an agency to do a cost-benefit analysis, frequently, if they do it right, it's only the marginal cost and the marginal benefits of that rule that's being proposed. It doesn't talk about the cumulative effect of piling the barnacles up on the hull of the ship that are frequently in conflict or overly burdensome and not tailored based on a bank's size, complexity, or business mission. And I really believe that's why this bill is so badly needed. Also, pursuant to congressional act, too often, many rules are rushed through with little or no substantive quantitative analysis on their economic impact, even at the marginal basis I used in my example. And that cumulative impact hurts our financial system, hurts access to capital for our small businesses, for our families, reduces and increases the compliance burden way beyond what perhaps even the author's original intent. This piling on of layer after layer of red tape reinforces incumbency, and increases consolidation by making the environment so prohibitively expensive for either de novo banks that we just talked about, or for mid-sized banks to cope with that compliance cost as a percentage of their deposits or a percentage of their operating expenses. So this is important that we have this statutory framework already existent from the 1996 EGRIPA Act, which was enacted during the Bill Clinton administration. And this bill simply builds on that existing regulatory framework by making this review every 7 years rather than the 10 years that the ranking member noted in her comments. And it, I think, will get a lot of public solicitation of ideas and make the regulatory process more harmonized, make the exam process more straightforward, and certainly take out conflicting rules or rules that are inappropriate for a particular depository institution based on size or complexity. So I thank the gentleman from South Carolina. I urge a yes vote on his bill, and I yield back the balance of my time. Does anyone else seek recognition on Mr. Timmons' A&S? Hearing none, we'll move to amendments. Do we have an amendment on Mr. Timmons' bill? There being no further discussion or amendments to the Timmons bill, the question now occurs on adoption of his amendment in the nature of a substitute. All those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. In the opinion of the chair, the ayes have it. The amendment is adopted. The question now occurs on ordering the bill as amendment to be reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. In the opinion of the chair, the ayes have it. Gentleman from South Carolina. Gentlemen, ask for a recorded vote. All those in favor of a recorded vote, raise your hands. A sufficient number having raised their hand, a recorded vote is ordered. Pursuant to subsection C5 of Rule 3 of the committee rules, a vote on this question is postponed. We'll now move to consider the next measure. Pursuant to notice, I call up H.R. 6552, the Bank Fintech Partnership Enhancement Act, which was introduced by the chair of our Financial Institutions Subcommittee, Representative Barr of Kentucky. The clerk will report the bill, which was distributed in advance.
H.R. 6552, to require the Board of Governors of the Federal Reserve System, the Comptroller of the Currency, and the Federal Deposit Insurance Corporation to study how partnerships between fintechs and banking organizations can support new banking organization formation and community bank health, and for other purposes.
Without objection, the bill is considered read, open to amendment at any point. Representative Barr has an amendment in the nature of a substitute. Copies of that have also been distributed in advance. Clerk will report that amendment.
An amendment in the nature of a substitute to H.R. 6552, offered by Mr. Barr of Kentucky, designated as Bar 122.
Without objection, the amendment is considered read, will serve as base text for purposes of amendment. Chair recognizes the gentleman from Kentucky, the chair of our subcommittee on financial institutions, Mr. Barr, to explain his amendment.
I move to strike the last word.
Gentleman's recognized.
Thank you. Today, I urge my colleagues to support my legislation, H.R. 6552, the Bank Fintech Partnership Enhancement Act. H.R. 6552 directs the Federal Reserve, FDIC, and OCC to conduct a study on the impact of bank fintech partnerships on the banking sector. The study would examine effects on competition, innovation, consumer protection, and the availability of financial products and services. It would also assess the extent to which such partnerships support new bank formation, reduce time to market for products and services, lower compliance burdens, boost customer acquisition, improve technological capabilities, and expand access to diverse funding sources. This is particularly true as it becomes increasingly expensive for small community financial institutions to afford the investments in technology that increasingly discerning consumers demand. And with all of the competitive pressures of that community banks face from larger institutions with greater scale and resources to invest in that technology, it's really important that banks have that opportunity, community banks have that opportunity to onboard those technological innovations in a bank fintech partnership. It also requires the NCUA to conduct a parallel study on credit union fintech partnerships for the same reasons. We have experienced a dearth of de novo bank formation due to a shift in posture towards these institutions under the Biden administration. Instead of encouraging a diverse banking system with many institutions, which is what makes the U.S. banking system so much stronger than Europe, former regulators encouraged excessive capital and regulatory requirements that have all but choked off new bank formation. That's why I was happy to see that the Financial Services Committee vote on a bipartisan basis in April to pass my bill, the Promoting New Bank Formation Act, to make it easier for new entrants into our banking system. In July, the committee also advanced the ranking member's bill, the American Access to Banking Act. The ranking member and I have both offered different approaches to address the problem over the past years, so I'm pleased that both of our efforts have broad support from the committee in this Congress. Now, we must continue to support this important issue by passing the Bank Fintech Partnership Enhancement Act on a bipartisan basis to ensure this de novo bank formation and innovation are properly studied and assess how bank fintech partnerships could enable new bank formation and for existing banks help community bank health and growth through partnerships with these innovative platforms. So with that, Mr. Speaker, I urge my colleagues to support this legislation. I yield back.
Thank the gentleman from Kentucky who seeks recognition on Mr. Barr's A&S. Gentleman from Ohio.
Move to strike the last word.
Gentleman from Ohio is recognized for 5 minutes.
Thank you, Chairman. I want to thank Chairman Barr for offering this legislation. I think it's really important that regulators get a view of how banks and fintechs are partnering, and I think this bill's well thought out towards that end. We've seen all kinds of kind of wrong-headed approach by regulators going back to denying Federal Reserve charters when the clear text of the Federal Reserve says that you should do that. Maybe they updated it and caught it after the fact, but I'm encouraged that the Fed is now talking about providing a path for fintechs to get charters. I look at some of the technology that's out there that fintechs are doing in the space, whether it's underwriting or data, that some small banks, community banks, don't have the resources. And how do they integrate that in? And where does the bank itself have responsibility? How do they follow that custody? I think that's really important. When I look at the work we did on stablecoins earlier this year, I've had conversations with some fairly significant sized banks who've questioned, should we participate in stablecoins? How would we participate in there? And I get that, they're generally conservative by nature, and some banks are going to be gun shy on that, particularly in the wake of choke point activities where the previous administration essentially went to war with banks that would partner in this space. And I think it would be interesting to know that the regulators are able to communicate with banks and say, here's some banks, not necessarily sharing inside information about another bank's business, trade practices, or anything else, but saying, here's how you might comply with this statute and still do some innovation. Because what we're seeing is a massive growth of non-bank lending. We're seeing all kinds of businesses that are adjacent to banks, in part because of regulatory burdens from Dodd-Frank era in particular. Also applaud Mr. Barr's tailoring bill there, but in part because they just don't have the certainty from regulators. And it's important that we provide the consistency here. So I think the study might be helpful towards us providing a more comprehensive law later. I don't always love the studies, but I think the coordination here is really important. And would the gentleman seek additional time?
Thank you. I'll just
Yield.
I appreciate the gentleman yielding for a brief additional point, and that is that everybody talks about, and not just in the United States, but around the world, this new ecosystem of open banking. Well, open banking, we talk a lot about data privacy. We've got some work to do there. CFPB is looking at 1033 and getting that right is important. But bank fintech partnerships is what we mean when we talk about open banking. We cannot have a flourishing open banking system where consumers have access to all of these innovative financial services and products if we don't get the bank fintech partnership model right and allowing that to happen. So it's important for new bank formation, it's important for community bank health, it's important for the diversity of the financial system, but it's also important for consumers, it's important for financial inclusion, it's important for open banking and this flourishing of this innovative new financial services ecosystem. So thanks for the gentleman yielding.
Yeah, thank you, and I'm glad the gentleman referenced 1033 and the CFPB because, look, that's an example where you really kind of do need somebody to be the referee and say, look, great fintech, but you don't get to access the whole intellectual capital and the bank payment rails for free. But the consumer, yeah, sure, the consumer should be able to share their data, work with the partnership, and adjudicate, well, whose data is whose there. And so there's some work to be done. We don't know whether CFPB is going to get that done, but that's an example of, in the absence of a good, thoughtful rule to lay that out, it would be good for us in our committee to do it. And so this kind of legislative approach, I think, is complementary towards that. And you can certainly allow the information sharing and privacy, but you make sure that people's trade secrets and their intellectual property, their invested capital is respected. So look forward to working on it, and I yield back.
Gentleman from Ohio yields back, who seeks recognition on Mr. Barr's bill. The ranking member of the full committee, Ms. Waters.
I move to strike the last
You're
one.
recognized for 5 minutes.
A broken clock is right twice a day, and once in a blue moon, even the gentleman from Kentucky, Congressman Barr, can draft a bill that has the potential of gathering my support. Community financial institutions are increasingly partnering with the fintech companies to help them compete against the mega banks and big bank firms that have increasingly entered the financial marketplace. This is an issue I routinely hear about from our CDFIs and MDIs. In June 2022, I sent a letter with Senator Warner requesting GAO conduct a study on the technology challenges they face. GAO found that, quote, many small CDFIs and MDIs reported they lack the technology needed to provide online services or to underwrite loans, manage operations, and conduct outreach more efficiently, quote, unquote. Limited technology, such as lack of ability to provide mobile banking, constrains their ability to serve underserved communities. Based on GAO findings, Senator Warner and I wrote the CDFI fund last year, urging them to use available funds to help these community financial institutions with their tech challenges. If done responsibly, these partnerships can expand opportunities in the form of access to financial services to households and businesses who are underserved. Now, these partnerships are not without risk, as we saw with the recent bankruptcy of Synapse, a middleware company that connects fintechs to banks. Based on our findings, Synapse held contracts with 100 fintech companies and 10 million end users, many of which had their accounts frozen for months when there was an estimated shortfall of 60 million to 90 million in customer funds that went missing. Since then, there has been limited progress toward better oversight of these bank fintech partnerships to ensure they help community financial institutions compete while ensuring there is adequate consumer protection. So I thank the chairman and his staff and the sponsor for being open to changes to the bill, to expand its scope to ensure there is consideration of consumer protection when studying these partnerships, along with adding credit union partnerships with fintechs. While I plan to support the bill, I also intend to offer an amendment to ensure we get detailed information about how these fintech partnerships specifically impact CDFIs, MDIs, and rural depository institutions, which I know Congressman Barr cares a lot about. Thank you, and I yield back.
The gentlewoman yields back. Who seeks recognition on the underlying Mr. Barr's A&S? Let's consider, if there's no other speakers on the bill, let's consider amendments. So let me turn back to the ranking member if you'd like to offer an amendment.
Yes, I have an amendment at the desk.
We'll pause while it's distributed. And Mr. Barr, did you have a motion? Gentleman from Kentucky reserves a point of order.
Thank you.
Clerk will report the amendment, please.
An amendment to the amendment in the nature of a substitute to H.R. 6552, offered by Ms. Waters of California, designated as H.R. 655201.
Without objection, amendments considered read. The gentlewoman from California is now recognized to discuss her amendment.
Thank you. I appreciate the effort to explore the benefits and risk to bank fintech partnerships. We know that community development financial institutions, or CDFIs, minority depository institutions, or MDIs, and rural depository institutions play a critical role in providing affordable financial products and services to communities all across the country that are overlooked by mega banks and other traditional financial institutions. While the underlying bill may cover these institutions that are community banks and credit unions, there is no stipulation that we get detailed information about how these fintech partnerships affect these type of institutions and the communities they serve. So my amendment simply ensures regulators don't overlook CDFIs, MDIs, and rural depository institutions when they carry out this study to ensure Congress has the information we need to fully support all of our community bank and credit unions. So I urge members to support this amendment, and I yield back.
The gentlewoman yields back. Mr. Barr, do you insist on your point of order?
Withdraw the point of order.
The gentleman withdraws point of order, and is there further debate on Ms. Waters' amendment? Gentleman from Kentucky.
Well, I move to strike the last word.
Gentleman's recognized for 5 minutes.
Thank you, Mr. Chairman. And given that my good friend, the gentlelady from California, Ranking Member Waters, has already signaled her interest in supporting the underlying legislation, it is with some degree of trepidation that I urge my colleagues to oppose her amendment. But let me explain why I would urge my colleagues to oppose her amendment. It's not because I think it's not well-intentioned. It's that the purpose of the bill itself, studying how bank fintech partnerships can encourage new bank formation, helps CDFIs to continue their important work. And I know the ranking member cares very much about that. So such partnerships could improve the ability of CDFIs to engage with innovative technology and bring those advances to the communities they serve. I know that the ranking member agrees with that. And so to that end, this amendment I would respectfully submit is unnecessary. Under existing federal law, CDFIs are already covered by the provisions of this bill, and singling out CDFIs with this amendment would risk creating redundancy, confusion, or unintended carve-outs that could undermine the clarity and consistency of the framework that we're attempting to establish. For those reasons, I oppose this amendment, but I do appreciate the intention of the gentlelady's amendment, and I appreciate her signaling her support for the underlying bill, and I urge my colleagues to do the same.
Would the gentleman yield?
I do yield.
I appreciate the gentleman yielding. I want to agree with your analysis that I think while the amendment is well-intentioned, that the CDI and MDI and banks are fully covered by the gentleman's underlying bill. I want to compliment him and declare my support for the bill. This is so important that we get this right. Ranking Member Waters talked about the Synapse bankruptcy. There were a lot of confusions that came from that. There are customer deposits that are missing as a result of that are still being investigated. We had a bank in Arkansas that was involved in that, and it produced challenges there for that institution. We want to make sure that fintech partnerships with depository institutions work effectively, and I think this will be very, very helpful. For example, I think it'll lead to best practices on what a right partnership looks like. What is the contract? What are the obligations between the bank partner and the fintech partner on seeing that to fruition so that there's no I's dotted or T's crossed that are missed in the responsibilities under the federal compliance rules for that. I think that allows our banks to have new ways to attract customers, serve customers, perform compliance by bringing technology into the traditional banking business. So I think that's a real good output that can come from Mr. Barr's work. And secondly, on behalf of the examiners, one of our frustrations between the first Trump administration and the Biden administration is the seesaw of what is the regulatory supervisor's view on fintech partnerships, and can we get exam standards that are harmonized, that are across the board, the OCC, the FDIC, the Fed, the state bank supervisors, through the Federal Exam Council, that we can establish the right examination practices so that we have safe partnerships. So I thank the gentleman. It's Mr. Barr's time. I'm going to yield back to him. I just thank you for
Will the
yielding.
gentleman yield?
I will yield. Let me just add on to one point that the chairman made, and that is that the enormous potential, I know the ranking member is a big supporter of CDFIs for the reason that CDFIs offer financial inclusion opportunities for low and moderate income customers and Americans. I think the same is true of innovative fintechs. There's so many innovative partnerships that are out there that provide low and moderate income customers access to credit or advanced financial help, or managing their monthly budget, or giving them access to mortgages. So I think there's an alignment between the mission of CDFIs and healthy bank fintech partnerships. And with that, I will yield to the ranking member.
You have exhausted the time. You know what I wanted to say. Exactly what Mr. Hill was saying. My amendment would have strengthened what you say you want. Don't point to CDFIs if that's all I'm talking about. Don't forget, I've been the strongest voice during this hearing on rural banks. And so they're included in this, not just CDFIs. Don't try to make people think that is true. And thank you for using up the time.
Gentlemen's time has expired. If there's no further debate, the question now occurs on Mrs. Waters' amendment. All those in favor of the amendment shall signify by saying aye.
Aye.
All those opposed signify by saying nay.
You
Nay.
didn't say anything, so I win.
In the opinion of the chair, the nays have it. The nays have it, and the amendment is not adopted.
I request that you record a vote.
For what, the gentlewoman requests a recorded vote. Recorded vote is requested. All those in favor of recorded vote, raise your hands. A sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. Further proceedings on the amendment or postponed. We'll now move to the next measure. Is that right? Next amendment. I'm sorry, yes. Is there another amendment to this bar bill? No further amendments. Without objection, the previous question on the substitute is ordered, and recorded votes on the pending amendment is postponed. Once those votes are taken, the committee will immediately vote for the adoption of the amendment in the nature of a substitute, and then we'll consider the question to report the measure. We'll now move to the next bill. Pursuant to notice, I call up H.R. 5577, the NFIP Extension Act, which was introduced by Representative Garbarino. Clerk will report the bill, which was distributed in advance.
H.R. 5577, to amend the National Flood Insurance Act of 1968 to reauthorize the National Flood Insurance Program.
Without objection, the bill is considered read and open to amendment at any point. Representative Garbarino has an amendment in the nature of a substitute, copies of which were also distributed in advance. The clerk will report that amendment.
An amendment in the nature of a substitute to H.R. 5577, offered by Mr. Garbarino of New York, designated as ANSTO-HR 5577.
That sounds fully encrypted. Without objection, the amendment is considered read and will serve as base text for the purposes of amendment. And the gentleman from New York, the chairman of the House Homeland Security Committee, Mr. Garbarino, you're recognized on your amendment for 5 minutes.
Thank you very much, Mr. Chairman. I urge all my colleagues to join me in supporting H.R. 5577, an FIP Extension Act, which would extend the National Flood Insurance Program to the end of fiscal year 2026. Flooding remains the most frequent and costly natural disaster facing communities throughout the U.S. Year after year, it is flooding that causes the greatest amount of property damage to homes and small businesses nationwide. For millions of American families, the National Flood Insurance Program is not a luxury. It is a lifeline that allows them to protect their homes, their savings, and their futures. Lenders, realtors, small businesses, and local governments all depend on the certainty that the NFIP provides. The NFIP remains the nation's primary provider of residential flood insurance, covering the large majority of flood insurance policies nationwide. The program currently serves approximately 4.7 million policyholders and provides more than $1.3 trillion in total insurance coverage against floods. In districts like mine, many homeowners are required to carry flood insurance as a condition of obtaining or maintaining a mortgage. Without the stability of NFIP, families are left with uncertainty, home sales are delayed or canceled, and the local economies suffer. In my district, we have seen the consequences of catastrophic flooding firsthand. 13 years ago, in the aftermath of Superstorm Sandy, communities on Long Island and across the East Coast were devastated. Homes were destroyed, neighborhoods were submerged, and families who had paid into the National Flood Insurance Program relied on it to rebuild and do it smarter.
For many of those families, the NFIP coverage made the difference between returning home, and facing permanent displacement. Superstorm Sandy was a stark reminder that flooding can affect coastal, urban, and inland communities alike, and that the NFIP plays a vital role in safeguarding the financial stability of homeowners by providing predictable and affordable flood insurance. Since 2017, Congress has relied on a series of short-term extensions to keep the NFIP operating. This has resulted in multiple lapses in coverage, including recently a 43-day lapse during the government shutdown, leaving families exposed in the housing market in limbo. As Congress continues to work on the appropriations process and approaches the January 30th funding deadline, we must ensure the NFIP does not lapse again. Allowing the NFIP to lapse would have serious and far-reaching consequences. Borrowers would be unable to secure flood insurance required to close, renew, or increase loans on properties located in flood zones, and the NFIP would lose its authority to borrow from Treasury until Congress acts to reauthorize. The NFIP Extension Act will provide continuity and greater predictability for policyholders and communities. A stable and dependable flood insurance framework would help ensure that homeowners and communities nationwide have consistent access to coverage that reflects the realities of living in flood-prone areas. I hope my colleagues on both sides of the aisle will join me in voting for this bipartisan bill and provide the much-needed stability homeowners and communities across the country deserve. With that, Mr. Chairman, I yield back.
Gentleman yields back, who seeks recognition on Mr. Garbarino's bill. Ranking member.
I move to strike the last word.
Gentlewoman's recognized for 5 minutes.
The National Flood Insurance Program is a critical safeguard for homeowners who are increasingly and repeatedly threatened by flooding. While I'm pleased to see that Republicans acknowledge the importance of NFIP, extending the program to only September 30th, 2026 is the very least we could do. Extreme weather events are becoming more frequent and more destructive, and the NFIP must be extended and updated to reflect today's risk. Flooding is no longer limited to coastal areas. Inland and rural communities are now facing repeated losses, rising recovery costs, and growing insurance gaps that demand serious reform. Instead of fully engaging in that work, this committee has spent far too much time advancing policies that pad the pockets of the largest banks rather than focusing on making flood insurance available and affordable for Americans. How many hearings will our Republican colleagues hold between now and September 30th that will benefit banks? And how many hearings will they hold during that time which are focused on improving the long-term affordability and sustainability of the NFIP? What is your plan? I support extending NFIP today, but this committee must also commit to a long-term reauthorization and thoughtful reform to support American families. Thank you, and I yield back the balance of my time.
Gentlewoman yields back. Recognize the chair of the Housing and Insurance Subcommittee, Mr. Flood. You're recognized to strike the last word.
Thank you, Mr. Chairman. Just want to weigh in here. I support the National Flood Insurance Program Extension Act, sponsored by Representative Garbarino. This bill, as he said, would provide greater clarity to homeowners, insurance, brokers alike by extending the NFIP through the end of this fiscal year, September 2026. Given the looming end of January and the funding deadline, I think it's best that we extend it and give people the peace of mind to know they'll be able to get a flood insurance policy, because it gums up real estate transactions all across our country. As we all know, there was a lapse in NFIP earlier this year, and it was not good. Lapses in this program are bad for all parties. They prevent the issuance of new flood insurance policies, delay closings of deals, create just general instability in our market. We should all support proactive action to prevent another lapse. I support the bill and urge my colleagues to vote yes. With that, I yield back.
Mr. Chairman.
Gentleman yields back. Gentlewoman from New York, the ranking member of our Small Business Committee, you're recognized to strike the last word.
Thank you, Mr. Chairman. I move to strike the last word.
Recognized for 5 minutes.
Thank you, Mr. Chairman. I'm glad we are marking this legislation and extending authorization of the National Flood Insurance Program. The NFIP is key in making flood insurance available to homeowners, renters, and small businesses. Authorization for the program is set to expire this January, calling on us to act. The The program has been extended on a short-term basis 34 times. The time for a long-term reauthorization is well overdue. I have called for an extension of up to 10 years to provide certainty and allow us the time we need to work on the reform necessary to improve the program. To make progress on those reforms, I have introduced 2 pieces of legislation this Congress focused on the NFIP and addressing the affordability of flood insurance. My bill, H.R. 5500, the NFIP Administrative Reform Act of 2025, responds to several challenges policyholders have experienced with the program. Among its provisions, the bill cracks down on fraud during claim adjustment, creates clear guidelines for appeals, and requires that FEMA disclose clear information about coverage to policyholders. Each aspect of this bill is designed to improve NFIP oversight, efficiency, and transparency. The NFIP Administrative Reform Act was unanimously approved by this committee during the 115 and 116 Congresses. Mr. Chairman, I hope to have the opportunity to mark this bill before I get the hell out of here for good. The affordability of flood insurance premiums remains a serious concern. To that end, I have reintroduced the Flood Insurance Tax Credit Act, H.R. 5504, which will create a tax credit against certain flood insurance expenses. This will help make NFIP premiums more manageable for working families and increase the uptake of flood insurance. Work on the important measures presented by my bills and the NFIP generally require more time. Presently, H.R. 5577 prevents the NFIP from expiring and creates the opportunity for us to put forward a much-needed long-term extension and program reforms. I urge my colleagues to vote yes. I yield back.
The gentlewoman yields back. The gentlewoman from Texas, Ms. Dela Cruz.
Thank you, Mr. Chairman. I move to strike the last word.
The gentlewoman's recognized for 5 minutes.
I join Congressman Garbarino in support of H.R. 5577, the NFIP Extension Act of 2026. Before coming to Congress, I spent over 20 years running a successful insurance agency. I wrote many flood insurance policies. I understand just how critical these programs are, and especially in a disaster and flood-prone areas just like in South Texas. In prior years, we have seen the risks of letting NFIP lapse. It is devastating to home closings and brings uncertainty to would-be home buyers and the entire housing market. NFIP is critical, is a critical backstop that protects the people's single largest asset, their home. It is the responsibility of Congress to do our part and ensure we work in a bipartisan way to bring stability and certainty to the NFIP program. In lieu of long-term authorization, which I support, H.R. 5577 is a critical step to ensure Congress does our job to extend NFIP's authorization. I urge my colleagues to join me in support of this critical program and vote A on H.R. 5577, the NFIP Extension Act of 2026. Thank you. I yield back.
Gentlewoman yields back. Does anyone else seek recognition on the ANS from the Chairman of Homeland Security? Hearing none, we'll move to amendments. Is there an amendment? There being no further discussion or amendments to the bill, the question now occurs on the adoption of the amendment in the nature of a substitute. All those in favor signify by saying aye. Aye. All those opposed signify by saying nay. Opinion of the chair, the ayes have it. The amendment is adopted. Question now occurs on ordering the bill as amendment to be reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. Those opposed signify by saying nay. In the opinion of the chair, the ayes have it. Gentleman from New York?
I request the yeas and nays.
Gentlemen, request the yeas and nays. All those in favor of recorded vote, raise your hands. Sufficient number having raised their hand, a recorded vote is ordered pursuant to subsection C5 of Rule 3 of the committee rules. A vote on this question is postponed. Pursuant to the previous order, the chair declares the committee in recess, subject to the call of the chair. We will reconvene immediately following floor votes to vote on today's measures. After we vote tonight in committee, we will reconvene tomorrow at 9:30 a.m. to consider those outstanding legislative measures. Committee stands in recess. Committee will reconvene. Pursuant to the chair's previous order, the question now occurs on adoption of an amendment in the nature of the substitute to H.R. 6536. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it, and the amendment is in the nature of a substitute is adopted. The question now occurs on ordering the bill as amended, reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. In the opinion of the chair, the ayes have it. For what purpose does the gentleman from South Carolina seek recognition? A recorded vote's been requested. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered. We will now take the vote on ordering the bill as amendment favorably reported to the House. The clerk will open the vote. You'll vote electronically.
What, the number, bill number?
This is 6536, Rural Depositories Revitalization Study by Mr. Norman. Dead battery here, Dylan.
There you go.
Oh, there you go.
We got somebody coming in. Sessions. Some of the spacing got wonky in there, so don't judge me when you see it. Sessions and who else? One more. Ed's rounding them up. Foster.
I'm going to talk real slowly. Is there any member who has not voted? Is there any member who would like to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 50 and the nays are 0.
Majority having voted in favor, H.R. 6536 is amended. The bill is ordered favorably reported to the House without objection. A motion to reconsider is laid on the table. We'll now take the vote pending on ordering H.R. 6547 as amended favorably reported. Members will vote electronically. The clerk will open the vote. This is the least cost exception bill by flood. 6547, yeah. Is there any member who has not voted or would like to change their vote? The clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 50 and the nays are 0.
A majority having voted in favor of H.R. 6547 as amended, the bill is ordered favorably reported to the House. Without objection, the motion to reconsider is laid on the table. We will now take the vote pending on ordering H.R. 6555 by the Vice Chairman as amended, favorably reported. Members will vote electronically. Is there any member who has not voted, would like to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 51 and the nays are 0.
A majority having voted in favor of H.R. 6555 as amended, the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. We'll now take the vote pending on ordering H.R. 6556 by Representative Lynch as amended, favorably reported. Members will vote electronically. The clerk will open the vote. Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 51 and the nays are 0.
A majority having voted in favor of H.R. 6556 as amended, the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. We will now take the vote pending on ordering H.R. 6554 by Representative Dela Cruz as amended, favorably reported. Members will vote electronically. Clerk will open the vote. Is there any member who has not voted? Any member who would like to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 29 and the nays are 22.
A majority having voted in favor of H.R. 6554 as amended, the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. We will now take postponed votes on the pending amendments to H.R. 6550 by Representative Loudermilk. The first question is on the amendment offered by Representative Caston. This is Caston 090. The clerk will open the vote. You'll vote electronically. Here's one right here. Here you go. Is there any member who'd like to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 22 and the nays are 29.
A majority having voted against the amendment is not agreed to. The question now occurs on adoption of the amendment in the nature of a substitute. All those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it. The amendment in the nature of a substitute is adopted. The question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. In the opinion of the chair, the ayes have it. Gentleman from Georgia? The gentleman from Georgia requests a recorded vote. All those in favor of recorded vote, raise your hands. A sufficient number having raised their hand, a recorded vote is ordered. We will now take the recorded vote on ordering the bill as amendment favorably reported. The clerk will open the vote. Is there any member who has not voted or would like to change their vote? Clerk will close the vote and report. Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 29 and the nays are 23.
Majority having voted in favor of H.R. 6550 as amended, the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. We will now take the vote pending on ordering H.R. 6570 by Representative Fitzgerald as amended, favorably reported. Members will vote electronically. The clerk will open the vote.
This is an aye. This is an aye vote. You voted no. Am I up there?
Is there any member who has not voted or would like to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 52 and the nays are 0.
A majority having voted in favor of H.R. 6570 as amended, the bill is ordered favorably reported to the House without objection. A motion to reconsider is laid on the table. We will now take the vote pending on ordering H.R. 6546 by Chairman Williams as amended, favorably reported. The members will vote electronically. The clerk will open the vote.
Where's 46?
Is there any member who has not voted or would like to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 52 and the nays are 0.
Majority having voted in favor of H.R. 6546 as amended, the bill is ordered favorably reported to the House without objection. A motion to reconsider is laid on the table. We'll now take the vote pending on ordering H.R. 6553 by Chairman Barr as amended, favorably reported. Members will vote electronically. Is there any member who has not voted or would like to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 33 and the nays are 19.
A majority having voted in favor of H.R. 6553 as amended, the bill is ordered favorably reported to the House without objection. A motion to reconsider is laid on the table. We will now proceed to take the postponed votes on the pending amendments to H.R. 1181 by Representative Loudermilk. The question is on the amendment offered by Representative Liccardo. This is Licar 078. The clerk will open the vote. Is there any member who hasn't voted or would like to change their vote? The clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 23 and the nays are 29.
A majority having voted against the amendment is not agreed to. The question now occurs on adoption of the amendment in the nature of a substitute. All those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it, and the amendment in the nature of a substitute is adopted. Question now occurs on ordering the bill as amendment reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. Those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. Gentleman from Georgia. Gentleman from Georgia asked for a recorded vote. All those in favor of recorded vote, raise your hands. A sufficient number having raised their hand, a recorded vote is ordered. We will now take that vote on ordering the bill as amendment favorably reported. The clerk will open the vote. Is there any member who has not voted or would like to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 29 and the nays are 23.
A majority having voted in favor of H.R. 1181 as amended, the bill is ordered favorably reported to the House without objection. A motion to reconsider is laid on the table. We will now take the vote pending on ordering H.R. 6551 by Representative Loudermilk as amended, favorably reported. Members will vote electronically. The clerk will open the vote. That's actually, oh, that's right, yeah. A&S. Is there any member who would like to change, has not voted? Mr. Fitzgerald? Any member would like to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 53 and the nays are 0.
Majority having voted in favor of H.R. 6551 as amended, the bill is ordered favorably reported to the House. Without objection, a motion to reconsider is laid on the table. We will now take the vote pending on ordering H.R. 6544 as amended, favorably reported. Members will vote electronically. The clerk will open the vote. Is there any member who has not voted or would like to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 30 and the nays are 23.
A majority having voted in favor of H.R. 6544 by Mr. Timmons as amended, the bill is ordered favorably reported to the House without objection. A motion to reconsider is laid on the table. We will now take the postponed votes on the pending amendments to Mr. Barr's bill, H.R. 6552. The question is on the amendment by Ranking Member Waters. This is H.R. 6552-01. Clerk will open the vote. Is there any member who has not voted or would like to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 23 and the nays are 30.
Majority having voted against the amendment is not agreed to. The question now occurs on the adoption of the amendment in the nature of a substitute. All those in favor shall signify by saying aye. Aye. All those opposed shall signify by saying nay. In the opinion of the chair, the ayes have it. The ayes have it, and the amendment in the nature of a substitute is adopted. Question now occurs on ordering the bill as amended reported to the House with a favorable recommendation. Those in favor shall signify by saying aye. Aye. All those opposed signify by saying nay. Opinion of the chair, the ayes have it. Gentleman from Kentucky.
Have a recorded vote, please.
The gentleman has requested a recorded vote. All those in favor of a recorded vote, raise your hand. A sufficient number having raised their hand, a recorded vote is ordered. We will now take the vote on ordering the bill as amendment favorably reported. The clerk will open the vote. Is there any member who has not voted? Is there any member who'd like to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 53 and the nays are 0.
A majority having voted in favor of H.R. 6552 as amended, the bill is ordered. Favorably reported to the House. Without objection, a motion to reconsider is laid on the table. We will now take the vote pending on ordering H.R. 5577 as amended, favorably reported. Members will vote electronically. Open the vote. Shh. Everybody wait, please. I have a comment I need to make, so don't run off yet. Is there any member who has not voted or wants to change their vote? Clerk will close the vote and report.
Mr. Chairman, on this vote, the ayes are 53 and the nays are 0.
The majority having voted in favor of H.R. 5577 as amended, the bill is ordered favorably reported to the House. Without objection, a motion to reconsider laid on the table. Now, let's talk about time for tomorrow morning. Important announcements, a change from what was previously announced. Pursuant to the previous order, the chair declares the committee in recess subject to the call of the chair. We will reconvene tomorrow morning at 9:30 a.m. 9:30 a.m. The committee stands in recess.